All right, what's going on, everybody? Looks like we are live. Let me know in the chat. You can see and hear me okay. Let me know in the chat. You guys can see and hear me okay. Want to make sure it's working before we jump in. Do you need a $50 super chat? No. Is it telling you that to do a super chat it has to be $50? It shouldn't be. I don't even I don't even know if I can change that setting. I don't even know if that's something that I can change. It's not asking for $50. Hmm. I don't know, guys. I don't really know much about the super chats because I haven't eaten like the revenue produced by this YouTube channel has not been a significant percentage of my business revenue since like 2021. Um, for the first like year and a half, it was good. It was nice, but I mean, it doesn't even come close to paying for my team now, like my video editors and stuff. So, um, I have not. The reason I bring that up is because I haven't spent really any time trying to optimize channel revenue from super chats or memberships or anything like that because it's just a kind of a drop in the bucket. I do not know Casual Finance. I'm assuming that's a another YouTuber name, and I do not. Am I a watch guy? Yes. Well, it depends on what you mean by a watch guy. I really like watches. I have a pretty deep list of watches on my wish list. Um, but the one that I wear daily is just an Omega Seamaster 300 Heritage Edition. Can't let me see if I can get that to focus. So this is the one I daily. My wife bought it for me for my birthday last year. Just stainless steel. It's not a platinum or anything. Um, but I love it. It's you can dress it up, you can dress it down with the color. It goes well with pretty much anything. Um, and I have quite a few other watches that I want to get at some point, but because I know they're just like as long as you buy a good brand, a good watch made out of good materials, it's kind of like a savings account. The values can go up and down, obviously, and I would never buy one with a plan to try and sell it or make a profit on it later on. And so because of that, um, it's kind of like I don't view them as an investment, so I'm not that they're a very low priority purchase for me. And so I think it's fun to tie them to milestones um, or important events. But other than that, I don't think it's a very good financial decision to be spending a significant percentage of your income or wealth on things like jewelry or watches. All right. Let me do a quick market overview, and then we'll get into the questions. All right. Let me hide my face so that I'm not covering anything up. All right. So this is market action today. These are daily candles. This is SPY. Um, this is a just this daily candle so far. I mean, the market's not quite closed yet. We still got 25 minutes, but this is pretty bullish. When you see a large wick, um, that's a sign that the market was attempting to go that direction, and market sentiment switched enough to completely reverse that momentum and send it all the way back for a reversal. So when you see a big wick on top, that's bearish. You see a big wick on bottom, that's bullish. Also, we did fill this gap right here. Let me zoom in so you can see it a little bit closer. So this gap right here, we ended up filling with this candle. And again, fully recovered from. And we're currently above this level of support here. So there's some good support right around the 731 to 733 area. And so if we can close above that, it's a fairly good sign for the coming weeks. Not necessarily the next coming days, but this is now an intraday. So this is the minute chart. So we can see, again, this big sell off that completely reversed. And looking fairly likely that we will end up closing above here. Obviously, anything could happen towards the end of the day. If we on this stream, we'll be coming back to this. I'm going to be streaming for quite a while today, and so we could close lower, and then this could turn into a much more bearish candle. But Nasdaq looks pretty similar as well. Wasn't I mean, there was kind of a little gap here. And then treasuries, we're seeing similar reversal. We saw yields go up and then have come back down on the long term. Same with the 10-year, and then same with the 2-year. Oil is lower, but bounced off this support. I've been saying for a while that I kind of expect oil to stay in this area just because the fundamentals of supply and how that's been disrupted. I don't really expect oil to skyrocket past this level. Don't really think there's much of a good reason to expect oil is going to just start, dropping much lower than right here. Gold and silver still in their range. Nothing unexpected going on with gold and silver. The only thing is they're both below their 200-day moving average now, which isn't a huge deal, but it's a little bit more bearish in the short term than I maybe would have expected originally. Silver is a little bit below this support level, so we'll see where it ends up the next couple of days. And then Bitcoin looks like it might have one more little leg down here. We had this bear flag here that broke down from. And I said last time that if we do break down below this trend level on this bear flag, then I would expect a drop to at least, I think I pointed at this level first, which is the lowest that it got to back in February. We did hit that, but based off of this weak bounce, looks like it's pretty likely that we see Bitcoin break below that, which then I would put the lower target of Bitcoin somewhere around 50,000 before this selling is all over. But we'll see. All right, let's go to some of the questions that you guys have thrown in. Okay, from Pox 2468. If silver increases significantly in a short period of time, can it be a good idea to trade it for gold or land? Yeah. I mean, at the end of the day, it is silver. You need to approach it as if it's an asset, just like any other asset. I don't look at it like a savings account, like I do gold. And I don't look at it like a potential future competitor for global reserve currency, like I do Bitcoin. It's like an industrial asset. It's like like other commodities like copper or zinc or platinum or palladium or anything. It's most of its value comes from its industrial usefulness. And so I'm bullish on silver in the long term, but there are certainly times when it gets overvalued, certainly times when it's undervalued, and you can trade around that. And so in times when it's gone up a significant amount and you expect some profit taking, then yeah, take some profits and use it to buy other assets that you think are undervalued. Nice guy 0001. Quartz keeps time better than everything. I never understood watches. Why is watches such a thing in finance? That's a good question. So 100% like quartz is like when quartz watches were, invented and, became kind of mainstream, it was like obviously they do a much better job of keeping time. But this is something like one thing that's kind of interesting is that when technology gets to the point where it erases the necessity for a prior tool, sometimes it increases the either the nostalgic or the art level of value of older, less technically useful things. So here's what I mean by that. If you were to go back to the 90s and you were to tell everybody, or the 80s, and you were to tell everybody, hey, in the next 30 years, every single person on earth will have a digital camera in their pocket that can take an unlimited number of photos, and you can edit them on device an unlimited infinite number of ways to make the images look absolutely perfect or make them look however you want to make them look. Do you think in that future there will be more professional photographers or fewer professional photographers? The rational answer would have been, I think there will be fewer professional photographers. And in reality, today there are far more professional photographers than there were back in the 90s and in the 80s. And so, for whatever reason, the commoditization or almost the like making free of something that used to be valuable can paradoxically make that the prior thing that is less technically useful, it can make it feel more valuable and people prefer it for whatever reason. So in the age of AI, like this is one of the reasons why I'm doing live streams and I never did these before, because in the age of AI, the knowledge that somebody is real will increase value. Just knowing that you're talking to a real person, knowing that there's a real live beating heart, real opinions and real flaws that you can relate to, um, in my opinion, is going to make real human interaction experiences much, much, much more valuable in the future because the other things that used to need that human interaction become basically free and commoditized away through technology. So watches are a very similar thing where it's like nobody needs a watch to tell time anymore. Everybody has their time in their pocket on their phone. Like you can get the perfect time anywhere. So it's definitely not about keeping time. It's about having a piece of old school, like ancient technology, really, that like works in a really kind of interesting way. The gears and the intricate nature of how these mechanisms work, how old these mechanisms are, the artistic and technical experience needed to actually build them by hand, and then the way they look. They usually look very cool. Um, and so for whatever reason, it's like it's increased the value of that market because we don't need it as a utility anymore. It is just a thing for fun, just a thing for enjoyment. Um, and so it's weird sometimes that technology has that impact where it commoditizes and makes free the product that those devices or the old way of doing things used to deliver. And so it increases the nostalgic value of the old way of doing it. Okay. All right, lots of questions coming in. I'm going to try and get to them all. Let's see here. Got Grace XXX. Hey Joe, there's a Google extension called Stream Live that sends me an alert when you start a live on YouTube. That's good to know. I thought YouTube had a feature built in where it would send you a notification as well, like on the app. But if there's extensions that do that, that's cool too. There's always a Patek Philippe nicer than the watch you got. Yeah, there's a couple Patek Philippe's that are on my list. One thing I really don't like is the companies that play games with like fake scarcity and make you buy like 3 or 4 things that you don't want in order to get on the list to get the thing you do want. So probably if I ever get a Patek, it'll probably be used because I don't like playing games that, games like companies like Rolex and Patek play. It's one of the reasons why I like Omega because I walked in and I said, "This is the watch I want," and they said, "Okay, here it is." So, but yeah, I love there's a couple Pateks that I think are just stunning. Um, okay, next question from Nice Guy 001. Where can I get options data, like open interest on different options so I can see what prices on QQQ or SPX people are buying or selling around? Anywhere you trade options should be giving you that data. If they're not, then go trade options somewhere else. So whether it's Fidelity or Interactive Brokers or TradeStation or Moomoo or Webull or Schwab or probably even Robinhood, everywhere you look at the option chains, one of the pieces of the lines on the option chain, you're going to be able to see the Greeks, you're going to be able to see the volume, you're going to be able to see open interest on the option chains. There are some free sources that are not connected to an account, like I think Yahoo will have that information. There's some, probably some paid online sources as well, but anywhere you're trading options should be giving you that data. All right. From Ojai, Mr. E. What is your recommended portfolio breakdown for long-term investing? My favorite portfolio allocation, I call it my bulletproof portfolio, and it is 30% stocks, 30% real estate, 20% gold, 5% cash or cash equivalents, 5% Bitcoin, and then 10% for speculation, hedging, asymmetric bets. Um, The reason why is because it's a nuanced twist on a, kind of like the modern portfolio theory, standard portfolio investing, like the 60/40, um, where you have a decent amount in growth, a decent amount in income, and depending on your risk level, a certain amount in reserves. The reason why I like gold instead of bonds for that portion of my portfolio is because gold over the long term preserves your purchasing power in real terms after accounting for inflation, whereas bonds don't. Like typically, the real return on government bonds is negative. So, and then real estate, because it provides you income, you get the debt benefits, you get the tax benefits, as long as you're buying physical real estate, and then stocks for the growth. So that's the portfolio that I like. All right, from Apollo Braden, I'm down 100K, but I know I can turn it around in the next week or two if these options hit. Well, I guess it depends on the amount, like depends on what the percentage is. So if you're down 100K from 101K, then I would say that you probably want to pivot your strategy. Probably want to start focusing on increasing your income and building that back up again, and investing in something very conservative. Because the number one thing that is important with investing is risk mitigation. Losses are more powerful than gains, and so a 90% loss needs a 900% gain just to get back to where you were before. Whereas a 10% loss only needs an 11% gain to get back to where you were before. So losses are exponentially stronger than gains. You need exponentially larger gains in order to equal the same dollar amount of, of a percentage loss. And so, if you are investing or trading in a way that opens you up to the risk of large loss, then like fundamentally, you are almost guaranteed to never be able to build a significant amount of wealth. If you're only down 100K from a million, then you're down 10%. It's like, okay, no big deal. You're probably invested a little bit aggressively, but not too risky. All right. Question from Who's in Oeris. Do you think crypto move opposite to the stock market if we ever hit a recession? I think all of crypto is going to zero except for Bitcoin is going to continue to go up. Well, I mean that's my bet. I think that the most likely outcome is that Bitcoin will probably go to zero too. But I think its asymmetry is worth putting 5% into, because if it does become used as global universal money, it must be worth many times more than it is today. And given its characteristics and how it functions, it is it would serve the function of money better than fiat. And so the more people that realize that and learn about it, the more people who will voluntarily choose to use it, which means eventually it could just be used as universal money. So I think the odds, even though the odds are unlikely that it can supplant fiat in the long term, I think it's high enough that it's worth taking the bet with a small percentage of your portfolio. But everything else is going to zero. All right, from Boosted Ben 7528. What do you think about buying Bitcoin heavy on the next day drop and holding for 3 years? I personally don't try and time Bitcoin. I don't trade it. I put 5% of all of my invested assets. Like if you get paid and you're investing, let's say $1,000 or $2,000 a month, I take whatever the portfolio allocation is that I like. I just went over the portfolio allocation I told you guys, which would be 5% Bitcoin. So 5% of my paycheck is then going to go into Bitcoin. If I don't have consistent income and I have sporadic income, because maybe I'm in sales and I get, my income is from commissions and it comes in, maybe all at the end of the year or whatever, it's fine. Anytime I'm going to be investing, I'm going to allocate my new investments according to my allocation. And in the beginning of my investing journey, I'm going to be rebalancing basically through my new contributions. But once my account value is so large that my new contributions are a small percentage of my overall net worth, then I'll have to do some rebalancing by buying and selling. But in the beginning, all my rebalancing will basically come from my new contributions going in. And so I personally don't trade Bitcoin. I dollar cost average. I like buying every day, take advantage of the volatility, and I don't sell. Thoughts on Adobe? Let's take a look at the chart. ADBE. All right. So this is Adobe. You can see I've got the this bear flag drawn out on Adobe. And I did not draw this today. I don't remember when I put this on here, but it was not today. And so last time I looked at Adobe was honestly probably when I did my last live stream, because people ask me about Adobe all the time. So I probably was pointing this out on the last live stream and was saying, hey, look, we've got risk that this thing breaks down. And it looks like we just broke down. So we're still above support, horizontal support, I should say. But this is a short-term, fairly bearish setup here. Zooming out, we have some okay support here historically. Let me zoom in back here. Last time it was in this price range. So right where we're trading at right now, we have some okay support, but we have stronger support down here, right above 200. And that would probably be, let's see, 200. Yeah, that would be a decent little confirmation move after that bear flag down to about 200. So just this pattern, I mean, number one, it's true that Adobe is just, they're still making a lot of money. But the reason why it's been selling off is because markets don't care about markets don't care about current earnings or things that have happened in the past. Markets are they're future discounting machines, which means that all investors are trying to do is figure out how much should I be paying for this money printer? Because at the end of the day, that's what companies are. They are money printers. And so we're looking at this money printer and we're saying, how much do I want to pay for this money printer? And we are deciding that based on not how much money it's printing out every day right now. We're deciding that based on how much money we think this company is going to continue to print out into the future. Because hypothetically, if we could convince Adobe to give us dividends that were worth 100% of their profits. So Adobe just said, hey, we're not going to be reinvesting in growth or anything like that. We're just going to take all of our profits and reward our shareholders. We're going to pay out all our profits in dividends. The PE ratio of 14 means it would take us 14 years to get our initial investment back. And so in large cap stocks in the stock market, publicly traded markets, that's a pretty attractive PE ratio. But in the broader scheme of things, it's like you'd still want to you'd still expect a good amount of growth from this if you were going to be paying a 14 PE. And so the big drop off in the price here is because a lot of investors are thinking, you know what, I I think there's a very good chance that Adobe in 5 years or in 10 years will not be able to print as much money as they're printing today due to other, due to competition, especially AI. And so this is why I say that software can't be taken as like an all-in-one bucket. Sure, you might be able to have some, some decent performance if you go into like a, IGV ETF, but it's going to be held back by companies that I think, I always use Duolingo as an example, that, companies that go that are like almost destined, in my opinion, to go to zero. Where there are other companies that are going to be able to take the current technological revolution that's happening and drastically and rapidly increase the amount of money that they're making through efficiency increases and productivity and feature rollouts and all of that. Um, and so you want to take it on a case by case basis. And with Adobe specifically, I don't know. I don't have a strong enough opinion about Adobe to have a position in it either way. I'm not long, I'm not short. All right. Question from Grace: how to play a 10% drop on Micron? Option premiums too big to overcome. Um, Micron right now, the out of the money options, and maybe I shouldn't say right now, over the past month, 2 months, option premiums are they're very expensive. And so one way to mitigate that is to go deep in the money because and far out with leaps, because then you are paying a lot less for that time value. Number one, there's less time value built in because most of that value is going to be intrinsic value, and so you might be paying for a deep in the money leap. You might be paying $100 worth of time value versus an out of the money option. You might be paying $300, and that's all time value, nothing intrinsic. And so that's one way to get around that. Get it a little bit cheaper, but it also means that you're probably going to be giving up some of the upside, depending on how large you think the move is going to be from where we're at. If we take a look at the chart, we pull up Micron. If you think that Micron is going to move, let's see, let's say you think Micron's going to go all the way to 1500 soon. And you think that's going to happen by, let's just say, August. Let me draw that line by August. So you think it's going to generally follow this path. Then you have to just price out, okay, where do I get the most bang for my buck in that range? And so if you look at, let's say, the 1100 strike price call expiring in August, you might be paying $400 for that, which means that even if what you think is going to happen happens, you would make no money by the end of it because that move is already priced in. Whereas maybe if you buy the $1,400 options, maybe those are only $75 or $50. So maybe you have like a 25 or 50 or 100% profit potential on those option contracts, but maybe not. Maybe the 1400s still like cost $150. So maybe it's like if the thing happens that you think is going to happen, you actually lose money on that. And then when you go like to an in the money option, you look at like the 400, maybe that one is right now it's going to cost $700. And so the break even point is only $1,200 because, 400 plus 700 is 1,200. So any movement that Micron makes past 1,200, then you start making money on, but it just doesn't have a really high percentage profit potential because, by expiration, if it does move to 1,500, then the maximum that could be worth would be 1,100 for you, and you paid 700 for it. So maybe that's, what is that, like a 60 or a 70% profit potential on that trade. So maybe it's better than the shares, a little bit higher leverage than the shares, but then also you have a little bit of baked in safety where if it doesn't get all the way to where you think it's going to go, then you still make money on it. The place that you lose in a situation like that is like, what if the move is way larger than you expected it to be? What if this thing goes to 2,000? Then yeah, you probably could have made more money by buying something that's way out of the money that wasn't pricing in the move that actually happened. And so option markets work by, it's all of the potential buyers and sellers coming together and coming up with through auction, auction agreements, it's pricing in what the expected movements is because the sellers are betting that that move won't happen. The buyers are betting that that move will happen. And so the consensus at any given time is what the market overall expects that move is going to be. So you have to see what the pricing is to see what move is expected by the market. And if you think the market's wrong, then how much are you going to make on that? Okay. I'm going to try and get all the questions. Looks like they're coming in pretty quick, but I'm going to do my best to get to them all. Um, all right, from user HW blah blah blah. What do you think about the Middle East in the context of selling pressure on financial assets by holding sovereign funds from there to cover their economies? Selling pressure on financial assets. Oh, probably held by sovereign funds. Yeah, that's some of it. This is one of the reasons why, like we've seen. I've got a video coming out about this soon, but if you want to understand somebody's intentions, instead of looking at what they say, look at the results of their actions. Because especially for individuals, it's really hard to know what your true intentions are. But if you continue to repeat actions that produce results and you continue those actions, then those results are likely what you intend with your with the actions in your and the habits in your life. And so when you look at what the government is doing right now over the last year and a half, and you look at the results of all those actions, and the results of that being chaos, conflict, war, uh, gaining control of choke points, um, gaining control of strategic positions in the Western Hemisphere, uh, Venezuela, Cuba, Panama, Canada, Greenland. And I'm not saying that we have, gained control of all those. I'm just saying that there's at least been talks of trying to gain control of like 51st state and that kind of thing. And then you look at the chaos and, the Strait of Hormuz and the oil prices and the tariffs. And after World War II, the United States government was able to secure its position for the next decades because of the way that World War II ended. And that was the rest of the world was bankrupt. They had spent all their money on weapons from the United States. All the gold came to the United States. So the United States was rich. The United States was a manufacturing powerhouse. And we now controlled the global reserve currency because everybody else in the world pegged their currencies to the United States. What is going on right now seems to be an engineered or trying to manufacture a repeat of that, causing chaos, causing war, forcing the rest of the world to pay a lot more for their own defense. All that money comes back to the United States, the rest of the world forcing to purchase arms from the United States, increasing manufacturing capability here, bringing up a lot of money home, and causing dollar shortages that entrench the dollar as the global reserve currency for much longer. None of this is speculation, by the way. Look up the 2026 Department of War strategic plan, and you'll see these points are outlined. This was released earlier this year, and they said basically like, this is what we're going to try and do. And that's what they've been doing. And so I don't think it's wise to look at what's going on in the world and like think the results of what's happening is the goal. The volatility is the goal. The chaos is the goal. The war is the goal. The high prices that are crushing economies around the world is the goal. And you look at dollar shortages, you look at countries that are scrambling for crisis funds, you look at countries that are trying to get new swap lines established with the US to gain access to dollars. It seems like that is the goal. And before this war, the emerging markets were outperforming US markets. And since then, US markets have just taken off on a tear because the longer this thing goes, the more the United States will attract more wealth. Wealth will flee other areas that are not able to not able to perform. And so the short-term volatility, in my opinion, these are just buying opportunities. Okay. Um, all right, gold and silver outlook. What about PAAS stock? We talked about gold and silver earlier, but you probably joined a little bit later, so we'll go over them again. Short term, this is a little bit bearish. We broke down below the 200-day moving average with gold and silver. With gold, we're still in this. I expect gold to stay in between roughly 4,000 to 5,500 for quite some time, similar to how we did this a couple of years ago after it broke out of this big trading range in 2019, had a big bull market, and then just consolidated. Volatility moved sideways for a couple of years, and then broke out into another big bull market. I think we're looking at something similar here with gold and with silver. Volatile sideways action. um, PAAS, Pan American Silver Corp. Um, Maybe a little bit oversold in the short term. It's not a bullish setup. I would, if I was going long here, I would make sure that I had a tight stop, or I was hedged, because we're really playing with the support here. We did break down and closed right at support. That's short term. That's a pretty dangerous or precarious place to be. And so short term, I would say we've got more risk to the downside, maybe down to around this 36-ish level here to get back to an area that has some stronger support. But long term, I don't know much about this company. I assume it's a $20 billion market cap company. They got a 1.5% dividend. They've got a decent PE ratio. Seems like they're probably a good company when you look at the long term. No red flags here from the chart. We've got some volatility during these years and a nice breakout here. Hey, look at that long term support that I mentioned around 36. That maybe a little bit higher, around 38. That coincides with old long term resistance. So coming back down to retest that after a big breakout like this would not be the worst thing in the world. That would probably be pretty good. If we hold above that, that would probably be an entry point. I'd be looking at somewhere around 40. All right. Questions. And I apologize for the delay in getting to your questions, guys. I'm going through these as fast as I can. I'll try and get to them all. All right. From Alperin Byrakter. If the Fed's shrinking their balance sheet, how are they going to print? The way that I read it is that they will not provide liquidity. They'll just print the good old way. Well, right now they are still expanding their balance sheet. So Kevin Warsh has stated that outside of an emergency, he doesn't think the Federal Reserve should be expanding its balance sheet. He thinks they should be shrinking it. But if you look at let's look at the last year, they are still expanding their balance sheet. They're buying short-term treasuries, anything under, I think anything under 5 years, but especially under 2 years. So they are expanding their balance sheet right now. The higher interest rates go right now, like long-term interest rates go, the more of an emergency situation that becomes, because the government just can't afford that. It risks plunging the economy into recession. None of the policymakers want that. Corporate debt defaults, private credit blowing up, pensions being put at risk of massive losses. So the way that I've stated for quite a bit now that I think they're going to handle this, to have their cake and eat it too, is bank deregulation, because banks are restricted in how many treasuries they can buy right now, just by regulations that were put onto them after the financial crisis that people like Scott Besson and Kevin Warsh don't think should be in place. And so if you unleash the banks to buy virtually an unlimited number of treasuries, then they do QE for the Fed, and the Fed can drain its balance sheet, and that can all get absorbed by the banks. And so the effect is very similar to QE. It's just a little bit more conducive for real economic growth because it also allows banks to lend to the private sector, instead of it just coming from the Fed through government spending. All right, from Rainer Honkler. Don't you think the Bitcoin sell-off is a little early? If the cycle holds, we should see the low in October. I mean, if we do see the low put in near October, because let's say the Bitcoin cycle is still intact, then doesn't have anything to do with the sell-off happening right now. Like, you could just see it continue to sell off until then. Um, just because a low gets put in October doesn't mean that it's not going to start from a lower place where it's at right now. All right, from AW Productions CA. Thoughts on keeping dry powder in short bonds versus treasury inflation protected securities. I don't like tips. I'd prefer just T-bills. I'd prefer money market funds. I'd prefer high yield savings accounts. Um, for keeping dry powder as well, like even T-bills, because I'd for dry powder, you want it to be dry powder. You want it to be really, really easily accessible to sell. And so for something like that, your money market fund is gonna serve that purpose because behind the scenes, that's in T-bills. And so you're getting pretty much the exact same yield. All right. Um, let's see here. Question from Rajesh Submarinian. For USD Global Reserve, is it being a part of global network is more important or macro eco political system within the US? Both are important, but which would be more important? Um, for USD Global Reserve, I'm sorry, Rajesh. I don't understand the question. You can restate it a different way in a new comment. I'll try and answer it. Um, all right. Question from JChan59. How does an average poor person survive immediate rising prices of goods and services when buying gold sells off? Um, I don't like the way that this like the assumptions that are and it's not you. It's not you. It's a very common question is like, how is the average person or a poor person supposed to survive by, when there's inflation, goods and services prices go up, and if they do have anything in assets, you're in the middle of a bear market or whatever. Because when you peel back the layers and you like look at the definitions of the terms, really what you're saying is, how is the person who is making incorrect financial decisions supposed to have results that are equal to correct financial decisions? It's like, you're not going to have that. The average person in America, the average poor person, the median household with median income, average net worth, average debt, like they're making bad financial choices, they will have bad financial results. The average person has a bunch of debt. The average person has the average car payment is what, like $750 a month now, something outrageous. The median household income is like $80,000, like nowhere near enough to support that high of a car payment. Um, the bottom 45% of American households carry a credit card balance. And that's virtually all the $1.6 trillion on credit card balances right now is all held by the bottom 40%. It's like, these are bad financial decisions that are keeping the average person and the average poor person average or poor. It's because of the decisions. And so when you the question that people don't realize that they're really asking is, hey, normal people who are doing normal things that are getting bad financial results, how are they expected to get ahead financially? It's like, you shouldn't expect them to get ahead financially. they're making the wrong decisions. So if you want to get ahead financially, you have to do something different than what most people are doing that's keeping most people in those bad financial decisions, which means you need to spend all of your time and energy on increasing your income. A lot of your spending focus should be on decreasing your expenses. It should be getting out of debt and then building up a savings account and then starting to invest in a very conservative portfolio so that you can get to at least 100 grand before you focus on active investing whatsoever. Because if you increase your return on $1,000, big whoop, doesn't do anything for you. Focus your time and attention on increasing your net worth first by increasing your income and keeping your expenses low. It's like you have to do all these things that most people never do. Then you'll be fine. But it's not the average poor person who's doing those things, and so they won't be fine. So don't be average. All right. Question from Sam LI90. What is the best way to sell a large amount of very deep in the money calls that I bought a while ago for max value? The strikes have low open interest and volume. Great question. This is something that when you encounter this problem, it can be scary. So a deep in the money option, sometimes, especially on some illiquid stocks, maybe the spread on that is so wide that you're looking at that and you're doing the math and you're thinking, if I sell this, I'm selling this for less than intrinsic value. You're like, I could exercise my option right here at $100 per share to buy these shares at $100 per share. And I could immediately sell the shares for $300 per share and capture a $200 per share difference, which means that I should be able to sell these calls for $200 per contract, but I can only sell them for $195 per contract right now. What is going on? The answer is just exercise. That's if there's a really wide spread because there's low liquidity, low volume, and you can't sell it for its intrinsic value, call up your broker and say, hey, I need to exercise these right now, which means I need to sell the shares immediately on the open market before I actually exercise the contract because I need to lock in this price. They'll do it for you. Immediately sell the shares, even though you don't have them yet. And then they'll input the exercise instructions for you so that your call gets exercised and you deliver the shares or deliver the purchase that, for the corresponding sale. And you're locked in now. So that's the way that you can get around that lack of liquidity on some of those deep in the money options. Most of the time that won't happen. It won't be a situation that you'll run into, but sometimes it does happen. Otherwise, if you're just saying, hey, I want to sell it for, the maximum that I can, and no matter what I sell it for right now, I'll be able to sell it. There's still some time value built in. It's well above intrinsic value. You can use a walk limit order, where you say, I want to sell it for, let's say $200. And then every minute or 2 minutes, it automatically changes that order, drops it by 10 cents or something. Just don't set that walk limit with a very short amount of time, like 5 seconds or anything, because a lot of times it will take market makers a bit of time to execute an order. And so you want to set at least like a minute or 30 seconds at the lowest in between the limit order changes. All right. Question from, super chat from Daniel Bachelis 9285. Thank you for the super chat. I appreciate it. Thoughts on ASAN, software company. Could a short squeeze be coming? Let's take a look. All right. Ooh, I don't like the I don't like the look of the chart. So whenever you're looking at could there be a short squeeze, you don't want to look at just short interest alone. So the short interest on ASAN is approximately 36% right now, which is very high. Most of the time stocks don't get up to, that high of a short interest. However, anytime a stock has fairly high short interest, there's usually a very good reason for it. It's that most of the market is, because the consensus is usually right, most of the market believes that stock should be headed much lower. And so everybody's trying to short it. And so the short interest goes up really, really high. So a high short interest alone does not mean a short squeeze is around the corner. Usually it just means the stock is probably headed lower. The short sellers are probably in a good position. Now, this company specifically, so Asana, ASAN is Asana. I just this is my opinion. I don't like this company. Um, I don't like the product. I've tried using it before. It's not terrible. I just don't I think there are probably better alternatives. So when you look at a company like Monday, I think this is, a direct, probably considered a direct competitor. Um, and we compare, let's see. So if we compare the overall shape, um, in the beginning here and back in 2021, these look the same, but you can see Asana has pretty significantly underperformed Monday over that same amount of time. Asana is down 83% from there, from Monday's IPO. Monday is down 51%. Monday is still above long-term support, whereas Asana continues to trend lower. Um, and And who knows? Maybe Monday's. I'm actually I have a small long position in Monday as well. So just for full disclosure, I do have bias on this opinion here. This is not just an unbiased opinion. Um, so I don't like the chart. It's also below its 200-day. This looks like this is not a very awe-inspiring setup for bulls. Um, The other thing that I wanna see if I'm looking for a short squeeze is really, really solid fundamentals that are improving, or a potential catalyst coming up around the corner that could invalidate the bear thesis. And so, um, one stock I've been vocal about that I think is primed for a short squeeze is Hims, because this is basically just like the FDA makes a few changes and Hims could skyrocket. They're pretty much set up for, just needing a regulatory catalyst to force all the short sellers to, their thesis changes, and this becomes um, a bull case instead of a bear case. I don't know if there's any potential catalyst out there for a company like Asana to do that, to like invalidate the bears. Um, this is probably an example of like a winner take all. Maybe not, but like, um, imagine, okay, 20 years ago, companies like CompUSA and Fry's Electronics and Best Buy and Circuit City, all the electronics stores companies, it's like they were doing great. And then slowly but surely, it was like people just stopped going in and buying their electronics at these stores because you could just get them cheaper online. You didn't need to go in and shop for this stuff in person anymore. And so it became like a whoever can last the longest ends up getting the rest of the business. And Best Buy ended up being like, it's like there's always going to be some demand for that, just not enough to support all the different companies. And pretty much everybody lost except Best Buy was able to hold out. And they're the ones that they're the ones that survived. Project management software might be similar. I could, might maybe won't, maybe not, but it might be a similar situation where it's like in the age of AI, where you maybe 90% of the use case for software like Asana and Monday kind of goes out the window. Maybe it's a scenario of like which one is the one that is able to outlast the rest, and then they get the rest of the business that for the small amount of demand that still exists for a product like that. I don't know. Um, all that being said, I don't like Asana enough as a candidate for a short squeeze to personally play it. All right. Um, from It's Chris Marcel. How do you think a currency change might affect asset markets? Currency changes really don't affect asset markets other than like when you look at a currency that is currently going through hyperinflation. Usually, the asset markets denominated in that currency look like a hockey stick. So when you look at like the stock market in Venezuela, stock market just explodes to the upside because it's like I'd rather put my money in anything other than holding the currency regardless of the price, because at least it's not going to lose value as fast as the currency. Same with like Weimar Republic in Germany, and it's pretty much every single time you see hyperinflation. And usually currency changes happen because one currency goes through some sort of hyperinflation, it loses its value extremely rapidly, and then it gets replaced by something else. But then what happens after that is that the assets are just priced in the new currency. And it's just a constant process of what is the value of that asset compared, like there's no There's no event where it's like there's like a repricing. It's like right now, for the last 10 years, you could look at the value of the stocks in Venezuela in their currency or in US dollars. And it's just a function of what is the value of their currency versus our currency. And so the value of their stocks priced in dollars just changes according to that along the way. Um, and so that's how currency changes impact markets. All right. Which matters more for dollar dominance? The network effect of everyone using it because everyone else uses it, or the underlying macro fundamentals like debt levels, inflation, and fiscal credibility? Okay, I understand the question. Um, Two parts to this. Number one, money is by definition the most saleable good, the most marketable good. In other words, money is the thing that people use. Money is the thing that people choose to use as money because they know everyone else is choosing to use it as money. I will accept something as payment for my labor, for my product, for my services, simply because I know that somebody else, that everybody else will also accept it as payment when I want to get something from them. That's all money has ever been. It is simply the good that people will accept because they know other people will accept it. So whenever you hear this idea that, oh, the dollar's not backed by anything, Bitcoin's not backed to anything. Well, when gold was money, gold wasn't backed by anything either. Gold is used as money simply because people knew other people would use it as money. So people accepted it as payment because they knew somebody else would accept it as payment. That's why it's money. It's the most marketable good. Um, and so the network effect is just a description of what money is. Now, that also means that there could be a situation down the road where that changes. And so that's the second part of the question is like the underlying fundamentals, the debt levels, the inflation rate, the devaluation rate, fiscal credibility, all that influences whether people will accept it as payment or not, because the one of the characteristics built into people accepting it as payment because they know somebody else will accept it as payment is that the value will be roughly the same. In other words, right now I can sell my services or my time for a month's worth of labor enough to purchase, a month's worth of living expenses. But if the currency is something that loses its value extremely quickly, then me holding on to that means that I might only be able to afford a half a month's worth of living expenses. And so the fundamentals of how a money is being managed is what influences whether people will be willing to accept it as payment or not. So as long as you have something that is considered to have the best characteristics and the best chances of somebody else accepting it as payment for the amount of value that I received in the beginning, then you have the fundamentals for something continuing to keep its network effects. All right. From Sir Calvin 83. Curious on your thoughts of a larger lump sum buy of Bitcoin. Putting in some earplugs right now in case you're wondering what I'm doing. Curious your thoughts on larger lump sum buy of Bitcoin at its current price. The 200-week SMA level is plus or minus 60K, and history shows it to be a fantastic long-term entry point. I almost exclusively always prefer. Well, it depends on what you mean by lump sum. Okay, so let's say you don't have a Bitcoin allocation right now. Then of your investable assets, I think it's most of the time a decent idea to say I'm going to just lump sum the amount of money that I need to get up to the percentage allocation that I want. Let's say 5%. If Bitcoin looks overextended to you, then it's also okay to say, I'm going to spread out these purchases over the next couple of months. If Bitcoin looks undervalued to you, it's, again, it's perfectly fine to just say, I'm going to lump sum that. Um, but if you already have the allocation that you need or that you're shooting for, then I would say dollar cost averaging usually makes more sense than trying to time it by lump summing more, because odds are it goes lower. Odds are it goes to zero. It is a more likely scenario that Bitcoin is not going to be used as money in the future than is. And if you disagree, like if you disagree with that, your percentage allocation could be reflective of that. The counterpoint that I'd have to that, like, let's say you are, for whatever reason, completely convinced that in the next 10 or 20 years, Bitcoin is going to be the global reserve currency. You still wouldn't want to have 100% of your assets in it, because the definition of risk is, what is the worst case scenario if you're wrong? And in that situation, your worst case scenario is you lose everything. Um, and you never want to bet the empire on a pot of gold. You always want to make sure that your number one rule is risk mitigation. You always want to make sure that no matter what, you don't expose yourself to a large loss. And so if you are going to go in heavy in terms of percentage allocation, you need to be very well hedged. All right, from Mr. Chadley T18. Kind of feels like the commodity super cycle thesis has died with the increase of interest rates. What are your thoughts? No, the multi-decade commodity super cycle does not change with week to week, month to month volatility. Nothing moves in a straight line. You kind of have to expect volatility along the way. But even if we accept interest rates as being a contributor to that, the higher interest rates go, the more likely it is that policy pushes interest rates lower. Because the higher interest rates go, the more risk to the entire financial system and economy that poses. And so if you think that higher interest rates are a threat to commodity prices, then this would be a buying opportunity, because that should mean that interest rates get pushed lower through policy. All right. From Jackson Pearson 3283, is Apple destined to fall a great deal more in price? Destined, no. So when you look at Apple, first of all, if you're wondering what that arrow is, that is when Tim Cook took over. And so if you measure from where Tim Cook took over to where he left as CEO, Apple is up like 2,000% in that amount of time. So just a really, really great run. He was pretty much exactly what the company needed. And now that John Turnus has taken over, new product person coming in, the guy who's like a lot more like Steve Jobs in terms of like what he's good at and what he's going to be focused on. I think that's exactly what Apple needs right now. So from a leadership perspective, I really like Apple. I'm pretty bullish on Apple because of their leadership and their product pipeline. I think that they, over the next year or 2 years, the number of products and the quality of products that they're going to be releasing, I'm very excited for. Number one. Number two, Apple does more buybacks than like anybody, and at the current pace, they could take themselves private within the next like 10 years. They purchase so much stock that it's very difficult for a company's stock price to fall if you're buying back. They're basically reducing their float by like 5% a year. And so it's hard for a stock price to fall when the company is retiring so many of its shares like that. So I like Apple. Now they are huge. And so a lot of people think, okay, well, how many more MacBooks could they sell? How many more iPhones could they sell? But I think I think the number of products and their profit, like I think it's probably their potential is larger than most people think it is. Consider for a moment, like, Apple's market cap right now is $4 trillion. NVIDIA's market cap is $5 trillion. I would argue that Apple has a lot more growth potential than NVIDIA. Um, a lot more potential product lines that they can get into and dominate. When you look at what they just did with the MacBook Neo, and I'm long Apple. Obviously, I'm a fanboy. Everything I have is Apple, um, except for my new Google Fitbit Air, which I'm testing out. Um, but I really like Apple, so take that for what it's worth. All right. Um, from JP Fowler. What do you think? A hard drop in the market in September, late or early October, because 4 to 6 months affects the war, the price of gas, and midterms. Looks like the perfect setup for a 20% correction. Um, maybe. I don't think that's the most likely outcome. When you look at the stock market over the past couple of years, um, we had a 20% bear market in 2018. We had a 35% bear market in 2020. We had a 30 or 27% bear market in 2022. We had a 10% correction in 2023. We had a 21% bear market in 2025. We had a 10% correction this year in 2026. The frequency of corrections in bear markets over the past 5 to 10 years is more frequent than the last 50 years would suggest, uh, would have been likely. And so the idea that markets only go up is just not correct given recent market action. These corrections and bear markets are healthy. They are fuel for the overall longer term bull market for sure. And I think people just don't realize how severe the corrections in bear markets have been over the last couple of years, and then and B, how frequent they have actually been. And so they just see the overall long-term trend and think, "Oh, we need to have a bigger correction here." And they forget the fact that when we got the great financial crisis that caused a 50% crash and it took years to get back up to break even, was because of one of the most over leveraged American, it was the most over leveraged American situation and deleveraging of American households probably since the Great Depression. I don't know how it compares, but at least since 1970. Uh, and so everybody became forced sellers because nobody was able to come in and be a buyer. Everybody was forced out. Everybody had to sell. That's what causes these things. And the leverage across American households is just it's actually at the lowest point it's been in 50 years. So it's really hard to have an economic collapse like the great financial crisis with the impact on markets when most American households are sitting there with dry powder and basically no leverage and very, very little debt compared to their assets. It's hard to get people to become forced sellers. And so you get quick dips that get bought back up. And so this 10% that happened at the beginning, earlier this year, that's fuel to send this thing much higher, in my opinion. All right, from Daniel Bachelis, are 0 day till expiration option income ETFs ever worth it? It seems like all they ever do is erode principal. I I think it's usually a good move to stay away from any structured income product whatsoever. So any financial instrument that uses a derivative strategy that's available to the public markets is usually going to be a just a a loser over the long term. Whether that's covered call ETFs, cash secured equity put ETFs, um, uh, 0 day till expiration option, selling ETFs, because number one, they open themselves up to the risk of having to sell at a loss and then get back in at a worse price because they're continually rolling over the same strategy rather than dynamically adjusting it to the market conditions and just holding off until a better situation comes around. Um, and so a lot of these strategies, they'll work better if you do them on your own in your own account because you can just use discretion. You can say, well, I'm not going to sell right now, sell a contract right now because the pricing isn't worth it. I'm just gonna sit on this or hold on. Or if the price skyrockets unexpectedly, maybe you roll up and out instead of getting called away. There's all sorts of different things that you can do that ETFs don't have the ability to dynamically adjust because their strategies kind of have to be locked in due to regulations. And and so yeah, I so far have not found any um any structured income product that outperforms just the underlying. So I don't touch them. If I want to do that strategy, I'll do it myself. All right. Um from Rajesh Submarinian, do you have any educational products on macroeconomics? I'm new to this and I've been enjoying learning about this and your community feels niche, although you have 500,000 subscribers. Um Almost. Well, I just crossed over 400,000 subscribers on YouTube, so thank you to all of you who have been around for a long time, and anybody who is recently subscribed just passed over that 400 mark, so that's exciting. Felt like I was stuck at 399 for like months. Um, my my paid community, it's a trade alert service, and so my personal performance trading over the last 5.5 years is 39%. My average annual return over the last 5.5 since 2020 is 39%. So that's about a little less than triple the stock market average. And so a couple of years ago, I just decided, hey, I'm going to start sharing the trades that I'm making, and this is with a portion. This I talk about 10% in speculative trading. So this is with a portion of my account. So a couple of years ago, I decided to start sharing the trades that I was making with people who their portfolios were in a place where they were able to do that with a small portion of their account, and that's been extremely popular. People have really enjoyed that. Um, my education stuff very soon here, I'm going to be you'll start seeing from me. I'm going to be opening it up access to just the education, my courses, just for free to the public, because I don't think, just from a business perspective, it's so easy to learn anything you want today for free that it's just not worth it for me to try and keep my educational stuff behind a paywall. And so I haven't even outright sold my courses in a long time. But I attach them as bonuses to signing up for my trading programs. Um, but I'm just going to be opening up access to them for free because I think it'll be much more effective for you to. I can just give you the education and the information for free, and if you want to follow along with what I'm doing, then you can pay me for that. Um, my education, like actual structured education products, like my courses, are not they're not exclusively on macroeconomics. They're more on like what to do, not how the economy works. That's really what my YouTube channel is for. So if you want more education for free on macroeconomics and how money works and how the economy works, it's pretty much every YouTube video I release. So just start scrolling through and watching those. Get a Whoop strap. I love it for sleep tracking. So that's probably in response to the Google Fitbit Air. So I got the Aura Ring, and that was the Aura Ring 4, and the Aura Ring 4 was huge, and they don't have half sizes. And so I couldn't find one that would fit on my right hand ring finger because I'm married, so I'm gonna want to wear it on this hand. And I thought that would look normal to have a ring here, but I couldn't find one that fit without it hurting the fingers next to it. So I was wearing it right here, and it just looked so goofy on my it was just huge. So I returned it, and then I got the Whoop. I really did not like the Whoop at all. The band was like the device was big. It just it felt like too bulky for me. I didn't like the way that the data came through. I don't like the $350 a year subscription instead of being able to just pay for the device. Um, so I returned the Whoop, and then like a week later, the Google Fitbit Air came out. So I got this. It's so much smaller than the Whoop, and obviously it's cheaper, but I like the everything that it tracks. The app is great. Um, and so I like the Whoop so far. But now they just came out with the Oura Ring 5. So I'm like, I kind of want to try that one out again because it's so much smaller than the last one was. We'll see. All right, from Sneeder Solutions. Thoughts on the rate hike talk. Seems to be gaining more steam and belief, but I know you've said before that you'd be surprised that happened, which I agree. One thing I think is going to happen is that they're going to redefine inflation. They're going to come up with new metrics on ways that they're going to say, hey, the way that we've been measuring inflation is just inaccurate. So this new way we're measuring inflation is more accurate, and guess what? It's a lower rate. So we don't need a hike. Inflation is lower than we've been saying it was before. So we don't need to hike rates because inflation is actually lower than we've been telling you it is. So I think that's going to happen probably within the next couple of months. And number two, bank deregulation is going to allow economic productivity to increase because it will allow a lot of corporations and households to refinance their debt at lower rates, which frees up cash flow. And that freed up cash flow will then allow more investment in production and more consumption, which finances production. And because it's happening through profit incentives rather than through central intervention, like directly through, like stimulus checks or whatever, there's a profit incentive attached to that, which means a lot of it will actually go to increasing productivity a lot more than, something like 2020, 2021 money printing did. And because of that, that economic growth will then offset inflation that, the increased money supply would have caused on its own. And that'll give them the ability to keep interest rates lower where they want them. All right, from Crizzles. What do you think is going to happen with SpaceX? Larry Chang said that his grandma's Mahjong group is invested. Man, if there's ever a dentist test or an Uber driver test, that's it. Your grandma's Mahjong group is invested in SpaceX. That's a sign to stay away if you ever needed one. I've shared before, like, we all have people in our life where it's like, by the time they're talking about investing in something, it's like, okay, you're so far removed from like, financial information investing that by the time you get exposed to the idea and then make the decision to actually buy something, it's like, all right, this is the top. And vice versa. By the time they're selling their stuff, it's like, all right, this is the bottom. I think SpaceX. I did release a video on this, so I'd highly recommend going and watching it. It was one of my most recent couple of videos on these upcoming IPOs. There's going to be a lot of money from index funds, but especially the Nasdaq, that's going to be funneled in to prevent that will prevent an immediate price collapse. There's so much retail interest. There's so many retail individuals. It's like it's oversubscribed, I think, by like double right now. And so then you think, okay, well, there's going to be a pop and then a drop. But the other thing is insiders are allowed to sell into that. So if prices go up, insiders are allowed to dump more shares to keep the price suppressed. And so this is at least at the beginning structured in a way to be an exit for early investors that shouldn't leave retail as bag holders of a big, huge drop because index fund money comes in to hold the price up. And so um, I do think there's a very good chance that you'll have the ability to buy some of these IPOs at better valuations within the next year. Um, I could be wrong about that. Maybe they just go up from here, but they're expensive. Even in a best case scenario of what these companies are going to do in terms of revenue and profit over the next 10 years, they're it's expensive. It doesn't seem worth the price, in my opinion. That being said, I am one of those early investors. I'm not going to be participating in the IPO, but I invested in XAI, and so I will be one of those trying to get out, at least probably, maybe, at least partially. Um, and so just whenever I share my positions with you guys, I want to be clear. I do that so that you know my bias and you know my opinions. And because there's so like somebody just got arrested or was it arrested? Citron Research, the short seller, for like he would say his opinion about something and then the market would move when he released his opinion on it, and then he would take the opposite side, like he would close out his trade. Um, so I never want to even become, get close to that. So I will share my opinions with you guys and I will tell you what my positions are when I remember. So that okay, like, there's bias here or there's no bias here. And so his, opinion isn't very strong here because he's clearly not opinionated enough on that to have a position in it. So just want to be clear with why I tell you guys. It's not because I think that you should or should not do the same thing I'm doing. It's just so that either the conviction of my opinion. All right. Um, yeah, S&P did not waive their 12-month rule, but Nasdaq did, and I don't think Russell's come out with their opinion or their decision yet on that. All right. From Verinder Singh, any thoughts on the job number? Common people may not agree. Jobs numbers over the last couple of months have been the best numbers in the last couple of years. I think people largely expected a lot of job losses from AI, and one of the areas where you'd expect that the most to be like software engineers, and those job openings have been far outpacing other job openings for the last year or so. They've just been growing, and it's like when you have it when a new tool becomes available that makes people more productive, those people become more valuable, not less valuable. So, um, so I think that the jobs numbers, they might be inflated, but I think directionally they're probably correct. All right. In other words, you're voluntarily providing Google with your biometrics. Yeah. And so what? What are they going to do with it? Ooh, they know my heartbeat. They're going to sell that to advertisers. They're going to give it to the CIA. Like, well, yeah. Who cares? What are they going to do with that? What is the risk that I'm taking on with Google knowing my heart rate, my heart rate variability? All right, from Beyond T9001. You are delusional if anything Trump admin and the new Fed do isn't anything other than a grift to funnel more money to criminal cronies. Are you talking to me? I didn't say anything about him. You're delusional if it, who are you talking to? Somebody talking about Trump in here? By the way, the corruption is off the charts. Like, if you are talking to me, I 100% agree with you there. Like, it is astounding how much money, the massive, massive amount of corruption, insider trading, just massive trades that are taking place of both the Trump family and everybody connected to him right before announcements are made, right before news is released, right before decisions are made. The amount of money that the way that they pulled money in through the campaign and through the crypto stuff and through like literally every move along the way has just been a brazen, outright, like it's I don't even have words for it. It's very, very maybe some people aren't surprised, but it's just I still think it's shocking the amount of corruption and, just yeah, grift that's taken place with this administration. Um, Even something like the tariffs, how, Lutnick was, like, the one who was pushing for tariffs that were so high and calculated in a way that was, like, so egregiously and obviously not going to be able to hold up in court, and was simultaneously buying tariff refund rights from companies for pennies on the dollar. And so then when those tariff refunds came through, which were like almost not guaranteed, but very, very likely, it's like I think it was like is at least hundreds of millions of dollars in tariff refunds, um, potentially over $1 billion. Just massive, uh, massive, unprecedented levels of corruption. Very, very brazen. It's kind of shocking. All right. Um, from Armandillo 2D. Do you think uranium stocks will begin a downtrend from here? Would be great to see a chart of URA. No, I'm pretty bullish on nuclear and uranium. We're in this we are with URA, we are under the 200-day. So short term, there's not a super bullish setup, but we're above this nice support level here. We're inside this range. Just this kind of volatility, like when you look at what it's not an unusual level of volatility here. Doesn't, in my opinion, negate the longer term bull market that we're in here. Um, Especially given the massive push from the Department of Energy and like every large tech company on, hey, we need to get cheap energy built out for ourselves. Um, Longer term, the only thing that can produce enough energy at a low enough cost in a clean enough and safe enough way is nuclear. I mean, it's not even close from every metric. Nuclear blows out of the water every other form of energy production, electricity production. Um, Safety, cleanliness, energy density, long-term cost, like everything. It's not even close. I'm super bullish on it. So these short-term movements, I'm not concerned about. All right. From Momo Monserrat. Hey, Heresy, what's your email? I have a ton of questions. I might not be able to ask everything here. I do not do anything one on one. Even the people who pay me a lot of money for my private groups, uh, I don't do anything one on one. And the reason why, just to be straightforward with you, is because in order for me to sell my time at a rate where it was like worth it for me, given the amount of money that I make per year and the number of hours that I work, for me to spend an hour or 2 hours answering an individual's questions, answering an email, getting on a Zoom call, anything like that, I would have to charge so much that it would only be worth it to somebody who already had a net worth of $10 million plus. Um, and I am not interested. I'm not, I'm just really not interested in helping somebody who's already high net worth optimize things to become even more high net worth. My The thing that I'm most interested is taking people who have gotten themselves out of broke and poor and getting you to a place where you can achieve financial freedom much faster. Like you're already investing, you understand the markets a little bit, you understand trading a little bit, you've got a decent income, you've got some disposable income that you're like, hey, I want to start accelerating my financial journey. It's like you've done the basics, you've gotten out of debt, you've done the little things right. So instead of getting you to financial freedom 40 years from now, let's compress that time and get you there much faster. So that's the area that I like to focus on. And the reality is just not worth it to you then to pay thousands of dollars for a 1 hour phone call. And I'm definitely not going to be answering individual emails just, for nothing as well. So unfortunately, that means that I don't do anything one on one. But on the upside, the plus side is that there's pretty much no question that any individual has ever had that I haven't answered in other forums in other ways, like through group stuff like this or through my other YouTube videos. Nobody's financial situation is unique. And so you stick around long enough, you're gonna get your the information that you need. All right. From Stanley Yelnats. Love the name, by the way. That was my favorite. That was my favorite book and movie growing up. Holes. Loved that. All right. What price of SpaceX would you consider selling your shares? I don't know yet. My my initial thought is to take out half of my initial investment when it's worth double my initial investment. That way, I can I can pull out everything that I put in and just like forget about the rest for the next 30 years. Just let that ride. If if it's a flop, it doesn't matter because my investment in it now is nothing. Um, if it does what it potentially could do, then it generates a significant amount of wealth. I have not made up my mind yet, though. I'm not sure. I'm not sure what I'm going to do with it. All right. Um, from James Collier. I agree with you. Who cares if Google gets your data? It's anonymous anyways, but they could tell someone's insurance company info and your rates could go up if not done correctly. That's a good point. That's definitely a risk selling data like that. Um, I think that's a risk for some people for sure. If you don't have life insurance, that could be a risk. If that's something that ends up behind the scenes, life insurance company comes back to you and says, "Oh, well, we were able to find data that shows like you have, some irregular heart rhythm, at risk for this type of disease later on, and so your insurance rates are going to be way higher." That's a risk. I think, like you said, I think that's illegal. But just because something's illegal doesn't mean it can't happen. Um, Personally, I'm not worried about that because there's I'm in I'm in very good health and I pay a lot of attention to it and I track my blood work meticulously. I, and so there's nothing in my biometrics data that would put me personally at any risk of anything like that. Also, I do my insurance much differently than most people, mostly self-insured because health insurance is largely a scam. All right. From Vrinder Singh, short-term 2-year treasuries going down. Expect doubt in growth. Um, no, just short-term volatility because of fiscal and monetary policy right now. All right. Um, from extraterrestrial travels, I pay for both of his services. They're definitely worth it. I've already got my portfolio to 100% year to date. Well, thank you for that public review there. Love to see it. That's the exciting thing to me is, when I first got started on my financial journey, I was, my wife and I were in a ton of debt. We spent the first year, we put her entire paycheck, her entire income just to getting out of debt. Um, Lived on literally $2,000 per month, um, $650 apartment. We worked nights, and so we didn't go out and see anybody. We didn't go to fancy restaurants. We didn't go on, expensive vacations, anything like that. It was like, um, very, very, very low budget lifestyle to get out of debt as quickly as possible. Um, we ended up getting pregnant very early on as well. And so when she quit her job to stay home, it was like we were used to that low level of income because we had already done it. And and so then once I did start making more money when I was a stockbroker, we were able to just, start piling that away very, very quickly because our expenses were so low. Um, and that kind of stuff in the beginning, I think there's so much public information about. It's pretty it's just straightforward math. It's like spend as little as you can, make as much as you can, take the difference, pay off your debt. Once the debt's gone, get a savings account. Once the savings account's full, then start investing in some index funds. It's so easy. It's not, I mean, it's not easy, but it's so simple. It's like there's no secret that's going to get you through that process faster. It's just like these are the steps. Anybody can do it. You just got to do it. And it's hard, but it's simple. So my favorite part is taking somebody once they've done those basics, then being like, all right, let's see how fast now we can get you to financial freedom. And the reason why I say financial freedom instead of retirement, I've talked about this before, but I don't believe in retirement. I think men especially, but humans, we are built to work. Um, if you look at it from like a religious perspective, in the Bible, the Garden of Eden, God puts Adam in the garden and he says, work it and keep it. And this is before the fall. Everybody thinks of work as like the curse that God placed on man from sin and said, like, you're gonna have to work the ground and toil and they think like the work was the curse. Work was not the curse. Work was given to Adam before the fall. It was in the garden, in perfection, when the world was, perfect and very good. He said, your job is to work. Like we are to go out and be productive and take natural resources and turn them into something that is useful and productive and profitable for us, make the world a better place. And so when we have the ability to achieve financial freedom, it means now we can walk away from the job that was killing us and that was soulless and that was mindless, mind numbing. We hated our job. We hated our boss. We hated what we had to do, the wake up early, whatever. And now we can focus on doing work that we think is more meaningful, even if it does cause a hit in the income. We can focus on the things that we think are more substantial, more important. And so I think that the faster the most people can get to financial freedom means the better the world will be because we have more and more people who can focus on doing really important work rather than the stuff that they personally feel is less meaningful just because they have to do it to pay the bills. So thank you for that public review there, and here's to hoping that we get you to financial freedom much faster than you were on pace for before. All right. From Vrinder Singh, you talk about deregulation. It didn't have an immediate effect, but when the Fed uses QE, it has immediate effect. In bad times, we need QE. We don't need it. There's no crisis right now, so it's not like there's no financial crisis going on right now. So there's no immediate effect needed. And also, markets are forward looking. And so, if you start to see something that is very, very likely to have a really good impact on the economy, that gets priced into the markets almost immediately, even though it doesn't affect the economy immediately. All right, from it's Chris Marcel, will the Clarity Act lead to crypto prices increasing? Yes, I think so. Um, Probably mostly Bitcoin. I wouldn't personally put any chips on the table for other cryptocurrencies, but I think the crypto or the Clarity Act passing will be bullish for Bitcoin. All right. From Anna Sabo, I love your philosophy of work. Question: would you buy a house in Atlanta in 2026 or invest aggressively instead and buy in a couple of years? Well, number one, you're always going to have to live somewhere, right? And so I'm assuming you're talking about buying a personal residence. And so the there there there's no right answer, by the way. There are multiple things that you have to consider for your own situation. Number one, if you always rent, you're likely going to be living in places that you don't find ideal. Now, there's certain people who like, maybe because you don't have kids or your kids are grown or maybe you're single or whatever, it's like, I want to live in a nice apartment building. And that's, I like the I like the city atmosphere. I like to, be able to move around from time to time, my job, whatever. For your own personal situation, if that's the case, then it's like, yeah, don't buy. You're going to save money on that down payment, repairs, whatever. You're going to be able to invest that in the market. You're going to do well. That's completely fine. Your personal residence decision is much more of it is a lifestyle decision rather than a financial investment decision, because there's pros and cons to each. A lot of people, especially once you start having kids, you're like, I want a backyard. I want to live in a neighborhood where my kids can play out in the front yard and I don't have to be worried about something happening to them. A lot of times, those neighborhoods are the ones where it's really hard to find a rental at a price that seems reasonable at all. And if you do find one, it's like that's the one house in that neighborhood that's like nobody wants to live there. And so, oftentimes it's that decision is like, it's a lifestyle decision. I'm going to pay more as long as I can afford it, then it's okay. I'm going to pay more to live in the place that I want to live. Maybe it's because I want to do certain renovations to it that I can't do in a rental. And again, that's fine. It's going to cost you more money, but it's a lifestyle decision. So then you just have to run the numbers. If my income never changes and if interest rates never go down, am I able to afford this place? And if I lose my job for 6 months, am I able to continue to still paying the mortgage? If the answer to those is yes, then it's like buy now because there's pretty much only upside from there. Capital appreciation, interest rates going down, your income going up, long term, you're paying down the debt, increasing the equity. Like there's especially 10 plus years, there's really only upside there. Um, you also want to make sure you're buying in an area that is like primed for growth. You don't want to buy a house in Detroit in 1980. Um, because there's no such thing as the US real estate market. There are just many, many, many real estate markets, and they're all different. Um, so lots of things to consider there, but don't frame it exclusively as a financial decision because you're always going to pay to live somewhere. So it's much more of a lifestyle decision for your personal residence than a financial decision. So you just have to run the numbers on, can I afford this if you want to buy? All right. Thanks for streaming, Big Dog. Thanks for calling me Big Dog. I'll stream as much as I can today. I'm planning on going longer. Um, are we back? Can you guys let me know in the chat if we're back? Just had it glitch out on me and it disconnected. We're back. Okay. Sorry about that. I don't know what happened. Um, from Sir Calvin 83, thoughts on raw land as an investment going forward into the future. I haven't seen anyone on YouTube that seems to give this aspect enough coverage as to potential growth in the future. Um, there are some people who are very good at investing in land. It's a job. If you are going to make money investing in raw land, you must treat it as if it's your business. It cannot be a hobby of yours. You need to spend all of your waking hours studying the land, studying the opportunities, looking at the development plans, looking at the trends. Like you need to know it better than anyone you've ever met. It's similar to like looking at Pokemon cards or art as, or numismatic coins as an investment vehicle. It's like the only way that works out for people is if it is their entire business and their entire livelihood. You know the market forward and backwards and up and down so that you know when you're actually buying something for a good deal. You look at the land, you look at the price, you know for sure you are paying less than what it is worth. Because if you can't say for sure that you are paying less than it's worth, then you should not be looking at investing in raw land. The reason why is because inherently, raw land is a liability, it's not an asset. It costs you money. You have to pay to keep that. It doesn't produce any cash flow for you. Now, because you said raw land. I think, yeah, you said raw land. If you're going to buy land in order to use it for a separate business, like you're going to put a lot on there, put some solar panel, whatever, shade structures, and allow people to park boats and RVs there for, a monthly fee, then you're running a business. That's not the raw land as the investment. It's just a purchase that's necessary to run your business. And then you run the numbers, like how much is it going to cost you? How much can you make on it? Like, again, it's a business. It's an asset then because it's producing income for you. But raw land just by itself, in the hopes that someday you can sell it for more. I mean, people have lost fortunes because they buy this land and then they hold it for 1 or 2 decades, and they have to pay the tax bill on it every year. And by the time they are able to sell it, they sometimes don't even break even on how much it costs them in taxes along the way. And you need it to more than break even to make up for the inflation that your money experienced along the way. So if it's your business and you understand it and you know it really well, and that's all you do, then yeah, great. Most people are not going to be doing that though. So for most people, you're going to lose money on that. From Birmingham J. I loved your recent video about the signs that the market may go higher. You look at stocks priced in gold, you look at peg ratios. What would you need to see to think the market is about to crash? Number one, I like to see euphoria. It's a hard thing to measure, but one way that you can see euphoria is when you see people who have no experience and really no business making money in active markets that are getting rich from it. So, like, a really classic example is, right before the financial crisis, the people who are making a ton of money on paper buying real estate. Most people who thought they were getting rich buying real estate in 2005, 2006 had they were the farthest thing from professional investors and knew very, very little about it, but they were still getting rich from it. Where the entire market has kind of a consensus opinion that it's only going to keep on going higher. So that's one thing, is leverage. I'm sorry, euphoria. Number two is a really high degree of leverage. And when you look at margin debt as a percentage of market cap right now, leverage is very low. When you look at total debt as a percentage of household assets, debt leverage is very low across the United States. So it's hard to have a big collapse when you don't have leverage that can be unwound. And so you want to see euphoria. You want to see consensus that it's only going to keep on going up. You want to see bears capitulating and really nobody, like all the people who have been perma bears throwing up their hands and saying, I guess it's just going to keep on going up. Nothing stops this train type of thing. And you want to see a lot of leverage. Those kind of things piled together are what end bull markets and end them for a long time. All right. From Red Sly Fox. I didn't know you were so spiritual and religious. I don't think anybody who knows me personally would say that I'm religious, because religious has connotations of like very strict adherence to ritualistic ceremony. I don't think that describes me very well. Um, I went to school to be a pastor. My bachelor's degree is in Christian ministry. I graduated with a ton of debt, and when my wife and I were trying to get out of debt, that's when I discovered how much I enjoyed personal finance. And then I had a friend help me get a job in a broker training program to become a stockbroker. And just I'd always wanted to do something in my life where I felt like I was helping people, and that was like that kind of like the unlock for me. Where I was like, "This is what I'm good at. This is what I enjoy, and I can really make a meaningful impact on people, helping them with their finances." When you look at like marriage, the number two or number three reason why marriages fail is financial problems. When you like money can't solve every problem, but money can solve every money problem, and most problems are just money problems in disguise. So, to the extent that I can help people financially, get on their feet and, get closer to financial freedom, I'm making their world a much better place, and because of that, they are able to make the world around them a much better place. Um, and so that's why I pivoted career-wise. Um, but beliefs-wise, I would call myself a follower of Jesus. Um, an unreligious follower of Jesus. All right, let's see here. Question from Sharavraj. I have every debt paid off except for my house debt, my mortgage. I bought a year ago, and it's so high at 7%. Any recommendation on managing it? I come from a cash-based society. This much debt is messing up my sleep. That high of an interest rate, I would say try and pay it off as quickly as possible. I know that it's probably a long journey, but something as simple as like an extra payment per year. And the way that you can do that is just by taking one payment. Like, let's say your mortgage payment is $3,000, or let's say $3,600. You divide that by 12, you get to $300. You add $300 onto each monthly payment. And that's probably something that you won't notice too much in your budget, but it'll pay down your mortgage just that much quicker. Obviously, if interest rates go down, then you can refinance, and that'd be great. But at 7%, like any amount of that debt that you pay down, that is 7% that you are earning for yourself. And you're probably going to do better investing in the market than 7%, but not every year. Sometimes you're going to lose money in the market. And that's a guaranteed return of 7% by paying down that debt as quickly as possible. If your mortgage was like 3%, I would say you're throwing away a lottery ticket by trying to pay that off early. It's like guaranteed that you're making money on that compared to just inflation. You could put your money in a high yield savings account and make more than 3%. But at 7%, it's like the risk there is much higher, and the math works out way better to just try and pay that thing off as quickly as possible. Um, all right, let's see here. From Michael Price, will the Fed allow the 10-year and 30-year Treasury yields to rise to 5 and 6% without manipulation? I mean, it seems like they're doing everything they can to not let it get there because they're issuing less and less debt at those maturities. They're doing buybacks at those maturities, and they're issuing more and more of their debt at the short end, in anticipation of action that will allow them to refinance later for lower. So it seems like at this point they're doing everything they can to stop that, and well, I think we're probably unlikely to see it get there and stay there before we get some sort of monetary or fiscal policy decision to try and push them lower. From George Talvin, what path can the economy take so that house prices go lower? I mean, massive, widespread economic collapse and interest rates going much higher from here. That would cause house prices to go lower. Um, I don't know what else. All right. I bought oil. This is from KY0611. I bought oil stock in 2020. At which point should you sell or hold on? Anytime you open up a position, you should have your exit planned before you enter. Because once you have money on the line, your emotions are tied to it. And you won't be able to rationally make a plan to exit once you have money on the line. Even Warren Buffett does this. His decision on how to exit is different than like a short-term trader. But if the fundamentals change, if the valuation becomes overvalued, if the management changes, Warren Buffett sells stocks all the time. I should say Berkshire Hathaway now. But when the situation gets to the point where he's like, okay, the situation has changed. Like, this is my exit plan. I will exit when we get here. Him and Charlie Munger have always said their preferred holding time for stocks is forever. But the reality is sometimes stocks hit their exit criteria. And so when you bought these oil stocks, what was your plan? Was it a short-term trade? Did you have a price target, a technical target in mind? Were you saying I'll get out when the oil price hits a certain level? So always have your exit plan both on the upside and the downside before you ever enter. That way you can make that decision rationally. Then always stick to that plan. Because if you change your plan once you have money on the line, you can never go back and see if your strategy actually works because you never stuck to a strategy. You just went on a whim and made decisions along the way based on how you felt. So you never have the data to look back on and say, okay, if I change this thing, then I would have had a better outcome. So set your exits before you enter and then stick to the plan and then adjust after you have a lot of data points. All right, CO Crew. Do you think it's possible for Kevin Warsh to turn against Trump given his official stance against QE? Yeah. I think when you look at everything that he's said, he's against the Federal Reserve completely independently determining monetary policy, not monetary policy, expanding its role outside of just setting monetary policy through things like balance sheet composition, balance sheet size, bank regulation, swap lines. There are a lot of things that the Federal Reserve does right now that, in his opinion, are outside of the tight area that should be considered independent. And in his stated words in testimony before Congress, he even said, like, they questioned him. They asked him, like, if what if the Trump administration or the Treasury directs you to do something, would you do it? And he said, the Federal Reserve is not independent in its decision making, even in the things that Congress has told the Federal Reserve to do. Even things like interest rates, employment, inflation. Those roles have been given to us by Congress. So we're not independent in those things in terms of like how we make those decisions. And so for a lot of things, we are going to defer to the authority of the Treasury or Congress. He said that would strengthen our ability to defend Federal Reserve independence in terms of strict monetary policy setting. And so I think that his stance on the size of the balance sheet is somewhat irrelevant given everything else, all the other changes that I think we'll probably see happen over the next 6 months, and that we could see things that, that we could see the Federal Reserve do things that it hasn't done in a very long time. We could see it drain its balance sheet, but still get the effects of QE from banks. All right. From Spencer6774. I sold a business last year on seller finance, and the buyer is about to refinance and pay me off in a lump sum. How would you advise investing a large amount of money in the market? Probably the same way that you would invest your income along the way in the market. So if you are a 60-40 investor and you like 60% in index funds and 40% in government bonds, then you would take your lump sum and do the same thing with that. If that scares you, then take the lump sum and divide it up over the next 6 months and go into that same allocation. My preferred allocation, I don't like 60-40. I don't like modern portfolio theory. Because the bonds don't give you the risk-free return that people think they do when you account for inflation. Bonds are more like return-free risk. Um, and so I like 30% stocks, 30% real estate, 20% gold, 5% Bitcoin, 5% cash, and 10% for speculation. You can do whatever you want, but I would say whatever your preferred overall allocation is, for like if when you get a paycheck and you're investing in the market, whatever your preferred allocation is, that's how you should do the lump sum. And if it scares you to lump sum into the market at these prices, then just split it up over the next however many months, because the point of wealth creation is to improve your life. And if lump summing that amount into the market at current levels makes you not be able to sleep at night, that's not improving your life. And so, there's nothing wrong with, like, ultimately, statistically, you will make less money if you have all that money to invest right now and you dollar cost average it over the next 6 months or 12 months. Statistically, you will end up with less wealth than if you lump summed it, because more often than not, markets are going up. So more often than not, you make more money by investing as early and as often as you can instead of spreading it out. But there are some periods of time where it does work out better, because if you happen to start investing at the time where markets are starting to go down, you do better by spreading it out. Um, the one thing I would not do is try and time the market and say, okay, I'm going to hold everything in cash and then wait for the markets to drop and then drop it all in, because you don't know how low the markets are going to go. And 9 times out of 10, what will happen is the market will drop a little bit. You think it's going to go down more. It will recover and start going up. And you'll be like, dang, I missed my chance. I'll wait for the next one and get it. And by the time the next one happens, it's never going to crash anywhere near enough for you to feel like it compensates you for all the growth you missed out on. And you'll just always be in cash from there on. And that's a very dangerous thing to be in. Missed out gains keeping you in cash. All right. From American POV show, if you have $1 million, what is a reasonable amount of annual income you could get from that? Um, it's a range, depends on how you invest. The lowest, like most conservative, like guaranteed amount, usually people say 4%. I think it's like you can round up to 5%, as long as you're not invested in exclusively in treasuries. Then, you have a little bit of allocation to, stocks, gold, some other things. Excuse me. Then it's reasonable to assume that you could safely take out 5% with a very, very conservative allocation and never worry about running out. For $1 million, that would be $50,000 a year. Now, some people say 10%, and that's doable. You have to be an active investor, though. I think it's a little risky to rely on a 10% number and just be invested in, standard index funds, because it's very likely that at some point you're going to need to take out that amount that you're reliant on when the markets are in a down year. And that will crush your ability for that dollar amount to then stay the same, because you're going to be taking out 10% from a much lower number during a down year. And then the recovery from there is not really going to be possible. So the answer, in my opinion, is for withdrawal rate is, depending on how you're invested, somewhere in between 5 to 10%, depending on how conservative or aggressive you want to be. From JP Fowler, FYI, you are great at simplifying some of the nuanced parts of macroeconomics. Well, thank you. That's one of the things that I enjoy the most, because I really enjoy when something finally clicks for me. When I study something, I was like, that doesn't make sense. That doesn't make sense. What is going on here? And then it finally clicks and I understand it. Then I'm like, all right, like that felt good to like figure that out, to understand it now. So I want to be able to share that with other people. Like, this is cool. I learned this. Here's how it works. I enjoy pulling the pieces apart until I understand how it works, so that I can then explain it to others. So I'm glad that you think that I'm good at that, because I do enjoy it. So thank you. All right, from Vrinder Singh, can I get a job as a stockbroker or any other entry-level job in finance without a finance degree? I want to learn, just want to do job related to finance, any way to get in. Yes, more and more these days, companies do not care what your degree is in. Many large companies still care that you have a degree because less and less these days, but it still demonstrates a couple of things. Number one, you are able to commit to something that doesn't have a payoff for a very long time. Like it's a, minimum 4 years for you to be able to. So it demonstrates the ability to commit to something for a long period of time before you get the reward for it. Number two, it demonstrates like it's like a little bit of like outsourcing an IQ test. Less and less these days, but it's demonstrated the ability to at least fake some sort of level of intelligence. And even the ability to fake a level of intelligence is like demonstration of some intelligence. Um, and so there is a a level of competence that can be demonstrated from most degrees. So it's less and less. I think in 10 years, most companies will not even care at all about any degree at all. But most companies today, if they care about a degree, it's not really about what degree, especially if you can communicate like how it might help you out in the role. Like if you've got a degree in uh behavioral sociology and you're trying to get into finance, you'd have to be able to like tell them, "Hey, look, I know this isn't directly related, but I understand more about how people work. It allows me to have a higher level of emotional intelligence. When I'm speaking with people, it allows me to relate with them better. That can translate into sales. That can translate into understanding what they're really after, whether it's customer service or understanding their fears to how they should be managing their money, whatever. So as long as you can somewhat relate it, usually it doesn't matter what degree you have. Most large financial companies will hire you at a low income, at a low salary, because they're paying you to learn. And so once they've paid you that, then that kind of unlocks the doors, and you can start increasing your earning from there. But just understand, most of the time, jobs are for learning, not for earning. And so um, go get jobs based on the skills that it'll give you, regardless of what you're earning, because those skills over the long term will compound a lot more than the salary increases will by just trying to climb the ladder or something. um, from Gilligan McKrebs, thank you for the super chat. I appreciate it. Huge fan of yours since I met you at the Silver Symposium in 2022. Oh, well, good to see you again. I agree with what the other guy said about how you break down and explain complicated topics of finance. Enjoy the coffee on me. Oh, well, I appreciate it. Thank you. Very nice of you. All right, let's see here. Next question from SCRN8TD. When do you think CBDCs will be implemented? Would it be a slow transition or would it be implemented overnight? Well, anytime somebody asks a question about CBDCs, the question that I always respond with is, how do you know we don't already have one? If they flip the system over tonight and the dollar was suddenly a CBDC, how would you know? And the answer is you wouldn't know. And the reason why you wouldn't know is because at the end of the day, the dollar is already a digital dollar. So a CBDC is a central bank digital currency. So what is the difference between that and the system we have today? The difference is where the ledger is. So the dollar is a ledger-based monetary system, and a ledger is just an Excel spreadsheet. Just think of it as an Excel spreadsheet. So every bank has its own ledger. It has the account numbers, has the names on the account numbers, has all your information, on that account number, and then it has the dollar amount that you have in that account, and then it has the transactions that happen in that account with the dollars coming in and going out. Every bank maintains their own internal ledger, and those ledgers are not public; they're private. They're controlled by the bank, and it's somewhat decentralized because each bank has its own. When you send money back and forth to other people, like when you go buy something at a grocery store, that money is not directly going from your account to the grocery store's bank account. If you have your bank at Chase and your grocery store has their bank at Bank of America, at the end of the day, Chase will say, all right, I've got $100 million of transactions going over to you, Bank of America, from all of my internal accounts, I've got $100 million going over to you. Bank of America says, okay, well, from all my internal accounts, I've got $90 million going over to you. And so instead of all those little transactions going like that, instead, Chase will just say, okay, here's $10 million. It's called batch settlement. And so one large lump sum transfer goes from Chase to Bank of America. And then Bank of America then distributes that into their own internal ledger. And they all keep track of their own internal ledgers. Those big batch transactions are recorded on a ledger up top, which is at the bank for banks, which is the central bank, which is the Federal Reserve. And so the Federal Reserve has one ledger of all the accounts that it has, and then each one of those banks keeps the ledgers for all of their accounts. A central bank digital currency simply combines all those into one big ledger that the central bank controls. That's it. The problem is there would still be the need for all the infrastructure to manage all of those transactions. That the banks would simply just be the infrastructure for the central bank digital currency. So you would still have an account or a wallet at Chase or wherever, even though behind the scenes, your account is now on the central bank's ledger instead of just at your bank's ledger. That means they have more control. That means they have more information. That means there's more potential for abuse. But in the day-to-day transactions, there's no, that wouldn't necessarily change anything about the way the dollar operates. So I think that it's likely that little changes happen over time that eventually get us to that point. But it is ripe for abuse. All right. From Got Grace. If a speculative position should be so small that it doesn't matter if it goes to zero, why would you sell half at double and half your opportunity? Um, well, number one, it's because if you take your position, once it hits double and you pull half out, your risk is now zero. Like you cannot, your risk, you have nothing left invested. So any return that you get from there is mathematically infinite because you have zero money in and it's producing risk for you. So the idea across the board is to hedge risk. One way to hedge risk is with position sizing. So I preach position sizing a lot so that if you have a speculative position, one of the easiest ways to manage your risk is to make it a highly leveraged position that is very small. That way, if it pays out big because it's highly leveraged. But if it doesn't, you lose a small amount because you've managed your risk with position sizing. And that can only be done with highly leveraged positions. Otherwise, the asymmetry is not there. And so with private investments, you don't have the ability to have that kind of leverage. So your position size has to be larger. Risk is always what is the worst case scenario. And the worst case scenario is always that it goes to zero. But in private markets, you don't have those leverage opportunities. And so you have to take it on a case by case basis and say, okay, I think the likelihood is here that we get an IPO. I don't think that this investment is going to go to zero. And so my position size was not small like some of my other trades in my trading account where I'm using options. And so in order to de-risk a larger position size, take some profits off the table. All right, question from Serge Chernata. Why heresy? When I was a stockbroker, so first of all, heresy is a word that means an opinion that is at odds with what is generally accepted. It's an old religious word. Galileo was called a heretic by the church because he said the earth goes around the sun rather than the other way around. They're like, no, the Bible doesn't say that, so you're a heretic. And heretics usually are telling the truth, and the establishment doesn't like the truth, and so they try and silence those opinions. And later on, it turns out, oh, we were calling them heretics, but they were actually right. That was actually the truth. When I was a stockbroker, I really enjoyed everything I was learning about the markets and the economy. I started studying and reading books and learning about how everything works just on my own. And it got to a point where I realized I didn't believe in what I was selling anymore. I didn't think the way that the mainstream financial establishment tells people to invest, like 60/40 portfolio, modern portfolio theory, index funds and bonds. I didn't think it was serving people well enough for what was coming. And the viewing things through the lens of like Austrian economics, um, when I have conversations with coworkers and people about this kind of stuff, it's like, dude, you're crazy. Like the only thing gold is ever going to be good for is throwing it through a window to, break into some place to steal food. Um, and so I quit in 2019. That was one of the reasons why I quit, to start Heresy Financial. And it was, I called it heresy because I felt like, my opinions were considered heresy by the financial mainstream. And I mean, you can see what stocks have done, you can see what bonds have done, you can see what gold has done, and you can see what Bitcoin has done since 2019 and 2020 when I've, started talking about them, and make up your own opinions about whether or not that was better than modern portfolio theory. But for me, it's worked out a lot better. So that's why the word heresy. All right. From Huckleberry Finn, how much do you recommend for emergency savings? I like 6 months to a year. I think anything longer than a year was worth of your basic expenses is just you're putting too much in savings that's just losing to inflation. Anything lower than 6 months, I think you're probably taking on too much risk because if you do lose your income, sometimes it can take longer for you to get that income back than you thought it would. And like, let's say for the first 3 months, you consider your full time job to be applying for jobs, and you're just 12 hours a day. That's all you're doing is trying to get a job, and you go 3 months and you still can't get a job. Then you have 3 months to try and maybe start something on the side and start a little business for yourself. I think that's a reasonable amount of time to be able to start producing some income. And so that's why I like 6 months, because it gives you a good buffer zone. I think anything longer than 12 months, though, you're just giving up too much to inflation. So you just look at your expenses and you say, okay, if I was in an emergency, I'd probably cancel Netflix. I'd stop eating at, ordering Uber Eats. I'd cut all my expenses down. What are my basic expenses? Multiply that by six, anything between 6 to 12, and that's the emergency amount. All right, from A Nasrallah. Love your videos, learned so much, saw your Century stocks, really liked most of them. However, nearly all of them are at very high valuations. How would you recommend buying them? The market assigns high valuations to things that it thinks it deserves. In other words, the question of valuation is always, how much am I willing to pay for this money printer? If the market overall expects that this company, this money printer, is going to be able to print out more and more and more money in the future, I'm going to be willing to pay more and more and more money to own that money printer. And so many times companies that have high but not extreme valuations, usually the market's right. So they tend to be good performers for the long term. Like the reason why Costco has such a high valuation is because the market understands, hey, they've got all these members who love shopping there, who just pay these membership fees. It's pure profit. Management is loved by the employees. The employees love their jobs. It's a very, very consistent money printing machine with consistent growth. It's like market's going to assign a high valuation to that company, versus something that is like higher risk. Maybe it makes a lot more money in the future. Maybe it doesn't. Sometimes the market's not willing to assign as high of a valuation to that. So, all right. Question from SO3365. If you're up 2,000% on Soxel and you want to hold it long term, can you short it sometimes to hedge yourself? If you are long something, you cannot short it. You cannot be long and short the exact same thing. It's both impossible from like the standpoint of like you either own it or you've borrowed something you don't own to sell it. Like the position wise, you cannot be long and short. And it also logically doesn't make sense. Now you're like, "Oh, I could do it in separate accounts." But it's like, okay, let's say you're long 100 shares and you're short 100 shares. Any gain or loss on either of the positions will be 100% perfectly offset by the other position. So you don't have a position then. It's the exact same thing as just owning nothing. It's just as cash. So you can't be long and short the same thing. So if you're long something and you want to hedge it, then you have to do that by like buying puts. If you are long 1,000 shares and you want to short 100 shares, that would be the same thing as you just selling 100 shares right now. So you go down to 900 shares. Um, the other thing is SOXL is that's the long one. Okay, SOXL. I was thinking SOXS. Um, yeah, that's the long one. And so if you're up a bunch on this position and you want to hedge it, then you buy puts. All right. From Jarrett 813, you just said bonds are not a great place to be, but what about the idea of placing some of your savings or short-term funds in T-bills? Yeah. So when I say bonds, usually I'm referring to a portfolio position of long-term bonds as like an asset class in your overall portfolio for like the reserves portion. I don't like that, but for the cash or cash equivalents portion of your portfolio, I do like that. Like T-bills, money market, high yield savings accounts. At the end of the day, anytime you hold a dollar anywhere, it's in T-bills, it's in bonds behind the scenes. Like you have cash in your checking account, you trace that back, see what the bank's doing with that. 99 times out of 100 behind the scenes, that's going to be in T-bills. And so, whether you have a high yield savings account or a money market fund, or you're in an ETF like BIL, or you're buying T bills directly you're doing a T bill ladder on Treasury Direct, yeah, it's basically all going to be the same thing. And so there's that's what I consider to be the cash portion of my portfolio, and whichever way you want to do that is great. Depending on where you live, it might be better to do direct ownership of short-term treasuries. You don't have to go through Treasury Direct. Through your many brokerage accounts, you can buy short-term treasuries just through your actual brokerage account. And because it's federal, depending on where you live, you avoid state and local taxes on that interest. And so, whereas if you're in a money market fund or an ETF, you don't get that waived. All right. From Doug Jinks, how would you compare your investments thoughts against Mark Moss? That's a good question. Short answer is I don't know. I love Mark. He's a friend of mine. I haven't spoken to him in a while. Um, we did some things together a couple of years ago. I attended a couple of his events, spoke at one of them. Did interviews on each other's channels a couple of times. Love him, think he's great, nothing bad to say about him. I don't know what his investment thoughts are right now. I haven't watched his YouTube videos or spoken with him in a good while. And so short answer is I don't know where we disagree. I don't know where we agree. And uh I think the main area would probably be Bitcoin allocation. I think he likes a much larger Bitcoin allocation than I do. Um, and to me, that's just a risk thing. It's just a risk management thing. He's much more confident in the future of Bitcoin than I am. And so I think a smaller allocation is better. But if he's right about the future of Bitcoin, then obviously a larger allocation would be better. All right, question from Live for Christ X91. Hey Joe, how you doing today, brother? Just tuned in and happy we got a live stream. I'm gonna have to go back and watch. Quick thoughts on the markets and precious metals. All right, so we haven't done since the market closed. We've been going for a while, but we'll go over the market here. So SPY did close above support here. Let's go to the minute chart and see what happened at the end. Yeah, that's a pretty bullish setup here. A little bit of a bleed off in the aftermarket here, but big sell off and then a really solid recovery across the market. It looks like Nasdaq is the same. So we closed above support with a pretty big wick on the bottom of the daily candle. That's a pretty bullish setup. I like that a lot. We got a big flush out. Probably a lot of people entered in short. we've got actually really high short interest in most of the stocks in the S&P 500 right now. Let me see if I can find that chart, because I think that's pretty interesting. Okay. So median single stock short interest within the S&P 500 um, is at the highest reading in over 15 years. So the last time we got as high of a short interest as we have right now was at the bottom, near the bottom of the financial crisis back in, what is that, 2008, 2009, 2010. So last time we had median single stock short interest this high was at the bottom of the market after the financial crisis. So that's a fairly bullish setup. When you have high short interest, it's a pretty bullish setup because you have a lot of people who have entered into sell positions that if the market or at some point they have to be closed out and turned into that's fuel for buying pressure. Um, what was the next thing I wanted to show you? It wasn't short interest. Shoot, what was it? Oh, Fear Greed Index. I haven't looked at this in a minute. Oh my gosh, look at that. Can you believe this, guys? And earlier today, we were lower. We were closer towards extreme fear, I believe. But the fear index is at 33 right now. And the market is the market is 3% from its all-time high. That's funny. So volatility, good, big sell-offs like that get recovered. That's in my opinion, a bullish sign. Gold and silver short term, bearish, drop below the 200, but we're still in this range. Silver is a little bit lower than where I thought it would. I thought we'd have a bounce here. We'll still see. That might be a false little breakdown. So short term bearish on the metals. Long term, just some sideways action. Nothing terrible. Question from George Talvin. And the Fed, central banks, is still on. Would it be better without them? We should remain only with private banks. So this is a question of like, would the world be better without central banks? I think the answer to that is absolutely yes. When you look at what the central bank does, it operates as a bank for banks. And because they have a monopoly on money creation, it allows them to do what they have done for decades, which is bail out the banks whenever banks take on too much risk. And so that creates a moral hazard that causes economic problems that then regulators come in and they use that bailout power to stop those economic problems from spreading. And it creates this reinforcing cycle where you have like excess risk and excess profits that bleed over into problems everywhere else. And so they come in and bail it out. And then to stop those excess profits, because we don't want to reward them for taking on too much risk, we pile on regulations to prevent them from doing things. And that creates shadow banking industries that cause more problems. And so this is why we have private credit, the private credit problem that's blowing up right now. We have all sorts of issues. And so you don't need somebody who can just artificially, arbitrarily increase the money supply. It's unnecessary. The money supply can expand and contract dynamically based on the demand for money, based on private lending with banks that can't be bailed out, because then if they go too far, the snapback contraction ends them. They took on too much risk. And people don't like that because it means your deposits are exposed to loss. But the alternative is your deposits are guaranteed to have loss through inflation. So I'd rather have skin in the game where you have to make sure your bank is doing the right thing with your money, because if they don't, they fail and your money's gone. I'd rather have that situation because then banks are very careful, because if they go under, they go under. They lose everything. And then if that happens, then every other bank down the line won't get deposits unless they can prove they're not going to do the same thing. So it makes a more robust system overall, number one. Number two, you don't need a central committee setting interest rates. Interest rates are the cost of money. The cost or the price of anything is best determined by the free market supply and demand. Money is no different. And so if the demand for money increases, then the price will move. If the demand for money decreases, the price will move. And that's based on the supply, which is the savings pool. So if the savings pool is very large and everybody has a ton of savings, then the demand for borrowing and the supply for lending, supply is huge for lending, so it pushes down interest rates and it encourages borrowing and spending. That drains the savings pool, and then it goes back the other way. And now the savings pool is drained. The demand for borrowing is, everybody's competing for those same dollars, and the people who are savers who can lend, they're scarce, and so they can demand a higher interest rate, and then that profit incentive drives more demand to save so that you can become a lender. And so it's a natural equilibrium that would automatically determine what interest rates are across the board, and it would be much more efficient, much more effective, and cause much less misallocation of resources and malinvestment. So we don't need the Federal Reserve. It doesn't do anything but cause more problems. But the people who have the power to decide to have a Federal Reserve are the ones who benefit by keeping it around. So it'll stay around. All right. Getting hot in here. The guy talking about extensions on Google is just trying to fish for crypto wallet keys. Don't use random extensions. Yeah, I don't think I saw anybody like actually hucking any links to get extensions. I think YouTube does a pretty good job of moderating comments. I don't think links are allowed in the live stream chats. But all right, from Pyromandin Powner. Do you think there can be velocity problems like liquidity traps without any leverage via QE type actions? Not an advocate for the first order effects of the Fed. Velocity problems without any leverage. I don't know, Pyromander. You're going to have to restate your question. I'm not really sure what you're asking. All right. Let's see here. From DCU 55, what are your thoughts on the SpaceX valuation? Do you think the rule putting it in indexes and multipliers are dangerous and this whole thing will raid people's retirement accounts? No. So, I mean, yeah, I don't think it's a good idea, but I did a whole video breakdown on it. So it's going to be hard for me to like give that level of detail here. So it's one of my most recent videos within the last couple of videos I posted. So go and watch that. Lots of money is being rerouted from other indexes. Most people are in index funds, and so you won't notice it because it's an internal rebalancing. So you don't notice any net change on the actual value of the index. It's just an internal. So if you're invested in individual stocks, you might notice a little bit, but it's not going to be anything significant. In fact, I think that the last couple of days there's been some dealer action to prepare for it, and so you might not notice literally anything. The money coming from indexes means that we're likely to see a couple of things. Number one, easy exit for early investors. Like Musk is known for being able to financially engineer things in a way where his investors don't lose. Like he will make sure that no matter what, anybody who trusts him early on gets rewarded no matter what. Like he's one of the best in the world who's ever existed at this, to make sure that if you invest with him early on, he's not going to let you lose. He's going to make sure you're at least made whole. So this seems like a way to make sure that early investors in XAI, in X, because X was moved over into XAI and then XAI was moved into SpaceX and now the IPO is happening. It's like these are all the steps in order to make sure that early investors can get their payday, because the early selling rules about how the early investors are able to sell, especially if the stock goes up, they can sell more. This is like unprecedented. Usually there's a big cliff. Now, the other thing that's actually kind of a bonus here is that usually all the retail hype will pump up an IPO, and then after the lockup period ends, it'll fall off a cliff. Since there's no lockup period, insiders and early investors can sell into that buying pressure. So you might not get the big pop. Now, that would mean that, okay, well, then retail investors aren't going to get what they think they're going to get, which is a big pop. And so maybe they all sell and it drops, but you've got money coming in from the index funds to kind of keep it afloat. And it's way more money than should be because of the multiplier effect. And so um, I don't know. This might be an example where we don't see the big pop and drop like you usually see in IPOs because of the way it's been engineered. But either way, I think the valuation is not worth buying. Can you look at Rocket Lab stock, RKLB? All right, chart wise, this is a very strong chart. However, short term here, this price action is probably a little bit more risk to the downside, not too much, but we're pretty extended from the 200-day. This stock looks like it has a fairly predictable pattern of having a big run up and then a sell off to touch back down on 200. Big run up and then a sell off to touch back down. Big run up and then a sell off to touch back down. Big run up. So I would say that there's a good chance that you might be able to have a better entry point. We did just touch down at this old resistance level as new support today and bounced off of that with the rest of the market. Um, but that's not a ton of support. So I would say that the downside risk in the short term looks a little bit higher. Um, and so if you're going to enter here, then I would, keep my stop tight, or stay like short term hedged. Um, You can also, I don't know if there's options on this thing, probably are. You could sell cash secured equity puts at lower prices to get paid for a limit order. If you're like, I don't want to buy here, but I would be willing to buy here, you can sell a CSEP so that you could get paid for that basically. Um, so this run up looks a little bit overextended, maybe a little bit more downside, but overall, this is pretty, a pretty strong chart. Um, this is nothing about the fundamentals. I think probably from a valuation perspective, I think this company is probably very overvalued and is just, running up in the big trend with stocks like these. All right, from Verinder Singh, any job title you suggest to get in finance as entry level? By the way, I'm in Canada. Well, first of all, I don't know Canadian markets at all. I would get any job you possibly can. Go to the biggest finance companies in Canada, apply at all of them for their entry level positions. Um, Talk around, go to meetups, find people, see if you can meet. If you know anyone who knows anyone who knows anyone that's in the industry, try and talk with them, ask them questions, ask for advice. Um, a lot of times with stuff like this, having somebody who can kind of guide you and tell you, hey, like you should do this is going to be very, very helpful. If you're a complete outsider. Um, but I think just getting your foot in the door is more important than where you get your foot in the door. Um, because once your foot is in the door, you have even couple of months experience. It's much easier to be able to use that as leverage to go somewhere else that is better, provides better opportunities. You can build better skills, that kind of thing. From A Nasrallah, who is your favorite super investor? Nassim Taleb, Mark Spitznagel, Peter Brandt, Bill Ackman, Peter Lynch, obviously Warren Buffett and Charlie Munger. Joel Greenblatt. I really like Joel Greenblatt. Those are the top ones that pop into my head. Um, From KY0611, if Jesus was a Jew, why is mostly everyone Christian? Christian just means follow Jesus. So Jesus said, follow me. I'm the way, the truth, and the life. So he said, follow me. That's all Christian means. All right. From Lawrence Thomas, thoughts on butterfly networks. It is disrupting medical ultrasound, will not budge to the downside. I don't know if I'm going to be able to find a symbol for this. Let's see. Butterfly networks. BFLY. If you guys want me to look up a stock, make sure you remember to put in the symbol for me. I was able to find this one easily, but sometimes I can't. All right. So classic IPO pattern, big pop and then big drop, slowly put in a big base, rounded bottom here. And then we're coming up on this resistance level here. I did not draw these lines today. I must have been asked about this stock before from one of you. And so this this false breakout here failed, but the low did not get put in as low as this one. So we got a higher low. So hitting resistance multiple times in a row while also putting in higher lows is a pretty bullish setup. We're above the 200-day. So this breakout here, technically speaking, is like, this is pretty good. Big pop, drop, and then back up above. I would feel very comfortable entering here as long as I have a tight stop, or maybe I hedge by buying a put at like, $5 or 450 or 4. Because once that breakout is confirmed, we've got probably a very quick ride up to $10. So this setup right here, that's a pretty bullish setup. All right. From Pyromandin, liquidity problems if the savings balance ratio is restrictive to market growth that has actually occurred, productivity, but the circulation velocity preventing that capital from being used. Right now, the biggest lever there is interest rates. If through anything, if whether it's through bank deregulation, yield curve control, QE, whatever it is, or just an unexpected amount of economic growth that offsets any inflation, whatever it is, what interest rates get pushed down, that's the biggest lever that unlocks the money to start flowing rapidly. From a household perspective, imagine you've got 15% interest rate on your car loan. It's a 12-year car loan, and it's $1,000 a month, and interest rates go down. So you're able to refinance that. And suddenly now you have an 8-year loan, and the payment on it is only $650 a month. Now you've got $400+ per month freed up that you can go do something else with. For an average household that is over levered, what they are likely to do with that is go consume more. Those households that are over leveraged right now, they will be consuming more of things that they have been tight on, because things for the bottom half have been very economically tight. So it'll be on a lot of things that are like considered like generally like more useful rather than on just like splurging in luxuries. That is more income that directly goes to companies that are selling and producing those things. So from a household perspective, freed up income means more revenue and profits for companies that they can use to reinvest in more growth, hire more people, increase earnings, salaries, that kind of thing. But corporations also have debt. And so they're able to refinance lower. That compounds things. Now they also have more money that's freed up, more cash flow that's freed up. Not only that, it allows the entire economy to increase its own leverage because the cost of servicing that debt just went down. So we can keep the cost of servicing debt the same by increasing our leverage. Um, and so I think I think the interest rates are the lever that moves that the most. All right. From Joke Kennedy 198, are all lives turned into shorter videos or are your main videos completely separate? Every one of my live streams, I have chopped up into the vertical shorts. Um, and so if you're ever on like YouTube, well, actually my long form YouTube videos, my regular ones that I post as like videos, I have those chopped up into shorts as well. So my shorts just are just clips from everything that I do on YouTube, including these live streams. The live streams, they serve a couple of functions. Number one, um, I think in today's day and age, knowing somebody is real, seeing their real opinions in real time, seeing their flaws, um, getting to know somebody, there's going to be a higher and higher and higher value placed on that in day and age where like a lot of content is just going to be produced by AI. The real human touch is going to be more and more valuable. So that's one reason why I'm doing the live streams more. Number two is because it's a way for me to get short form content out there. Um, it's kind of double dipping, and that's also why I do the Q and A's because it serves that function really easily. Like I just see the question, answer the question. Usually time wise, it's like pretty good to go up as a short. I post those shorts on Instagram as reels. I post those shorts on TikTok as TikToks. So it helps me get more content out there. So yes, all lives are cut up into shorter videos. And then my main YouTube videos, I still do that just like normal, like I always have. Like I come up with, the idea of what I'm going to make a video about. I make a video about it. All right. Um, from IC3 Blink, question about the 30% stock allocation. What is the diversification of it? Tech, medical, defense, etc. Well, that's up to you. The best starting place is just the index funds. So you could do like one total market stock index fund. You could do like, SPY, QQQ, RUT, or not RUT. What is the IWM? You can just do the index funds to start, and then so I've got two courses on this. I'm going to be opening up access to them soon, so stay tuned from that for me. One of them is my portfolio allocation course, going to be free, so it's not a sales pitch. I'm rolling out a way to get access to these for free. Anyway, portfolio allocation course, that one goes into the deep reasons why and the math behind it, history, all that, and just start off with index funds. From there, once you're investing a good amount and it makes sense for you to focus more on increasing your return, then it makes more sense to start moving into individual stocks. And so you've got to do some fundamental analysis. You've got to do some technicals. It takes work, which is why it doesn't make sense to do that at the beginning when you only have $5,000 to invest. It makes sense to wait until you're increasing your percentage returns on a larger sum of money. And so once you get there, then it makes more sense to start trying to pick stocks instead of index funds. All right. Anna Sabo, thank you for the super chat. I appreciate it. All right. What are your thoughts on DRAM and SOXQ? DRAM, I have a long position right now. Same thing with kind of the rest of the market. This big move down that had a big bounce today. We touched down on this support level and it was prior resistance here. So this looks like a pretty good bullish setup for me. Again, I am long DRAM right now. I think that we probably have a decent amount of upside to go from here before we get to the point where this little tiny isolated bubble pops. Probably the same thing with like SOXQ, maybe not as severe of potential upside percentage return, but probably um, a little bit more safe as well in terms of uh, downside risk. So I like them. Obviously, with anything, you want to make sure you're managing risk. You can do that through position sizing. You can do that through setting stops. You can do that through just watching it, watching it, manually selling when you hit a level that you don't like. Um, but however you manage risk, just do it. All right. From Silent Warrior, I would like to hear your thoughts on SKYT. SKYT, Skywater Technology. Well, I like this setup a lot. So we had a big run up that failed right here at 35, sell off, um, put in a nice little rounded bottom here. Like this is a pretty good cup and handle formation here. Broke through that prior resistance level and then came back down. The last couple of days have been retesting that resistance level as new support. It's holding so far. Um, Not fully confirmed yet. So I think it's worth an entry if you keep a tight stop. We do have some downside risk if that fails, probably coming back down to like the $26 level. By that point, I think the 200-day moving average will probably be pretty close to that as well. Um, but it's a nice bullish setup. All right, zooming out here, we see that we are also playing with previous all-time highs as resistance. So it's probably why we're seeing some trouble getting above it right here. But overall, longer term, this does look like a pretty good, pretty nice bullish setup. This would be, it's not the best looking bull flag, but it's a messy looking bull flag. So that's a bullish setup. Um, I don't know anything about this company. $1.7 billion market cap. Um, let's see. Don't pay a dividend. PE ratio is 15. That's pretty good. Um, so I don't know anything about this company does or why they're going up recently, but chart looks chart looks pretty chart looks decent to me. All right. Guys, I have to step away for a minute. I'm gonna be right back. If anybody comes in and asks in the chat where I am, just tell them I'll be right back. Let's see. How do I maybe I won't be able to do this. Okay, I'll be right back. Okay, I'm back. Thanks for hanging on, guys. All right, let's answer some more questions here. Um, I'm curious. This is from Louis TYT5BM. Curious about a European company called Dasty. Stock has been terrible, but I'm just curious. Thanks for what you do. Um, let's see if we can pull up the chart for that. I'm not sure what the symbol is going to be. I'm assuming it's, yeah, I mean, that does not look great. Like, first of all, we're below this old support level and looks like that's holding as resistance. We're below the 200 day. Big gap down, tried to recover, big gap down, tried to recover, big gap down, is trying to recover. Not the best sign. Technically speaking, looks like we've got significant downside pressure and downside risk. Packaged software, that's probably why. I mean, this looks like a typical software stock right now. So I would say that the market is pricing in some significant AI risk. That's what it looks like. Not the best look. From Nick, do you believe they are going to tokenize securities soon? I'm long on STEX, but who else will be tokenizing? There's no predictable way to profit off of that if that does take place, because it's just a behind the scenes technological change in the way that the asset ownership is recorded and asset ownership changes take place. And so, given the way that technology is developed, I don't think there's a very good predictable way to try and profit off of that change slowly taking place across markets. It's not like there's one, like a cryptocurrency that you can buy that's going to like go up as a result of tokenization. All right. From Topher, thoughts on high quality compounding value stocks in this market? Thinking semiconductors and growth AI stocks may slow. Been allocating to Copart, First Cash Holdings, and Intercontinental Exchange. Well, one of the problems with value investing in like the traditional sense is like you're looking for companies that the market is assigning a very, very low valuation to. And 9 times out of 10, there's a very good reason why the market is saying this company's not worth a lot right now. We're in a very different environment than the Benjamin Graham environment, where the market was assigning extremely low valuations to everything because we were coming off of the backs of the Great Depression. Back in that time, like it was very, very uncommon to be an investor in publicly traded equities. If you were like the vast majority of people just had like savings, and if you were invested, you bought bonds, like government bonds. It was not as common as it is today. Like stock ownership today is very, very high, historically speaking. And so it wasn't it we don't have a situation today where it's like we've got, cigarette butts lying everywhere. Where we've got across the board lots of stocks that are like really actually valuable, but for irrational reasons, the market is valuing them lower. We've got kind of like the opposite problem. It's like because of pensions and 401ks and passive investing in index funds, you've got money a couple times a month flowing from the entire economy to buy everything, regardless of value. So that pushes valuations across the board up. So if you have something that is like has a really low valuation, you really have to ask why. Like there's most of the time a pretty good reason for it. Every once in a while, you can find a really good stock that is undervalued um, for bad reasons, and the market is wrong. It's difficult to find, number one. Number two, a lot of the times what that looks like is actually a stock that looks like it's overvalued, but then everything else catches up. Um, so a lot of the high quality compounding stocks don't have valuations that by themselves in a vacuum look attractive. All right, from Mr. Riz, any speculation on when the Japanese bond market stops going parabolic? No, I have no idea when that'll end. No idea. All right, Rethink Rich. Any thoughts on RDW and RCAT? Redwire. Whoa, look at that. That's crazy. Obviously, I've looked at this stock before. Oh, I think you're probably the same one that asked about this a couple of times. We talked about the breakout here, struggle to get above here. It popped up all the way to here, and then it just sliced right back down through that support level, basically all the way back down to this one. So that's a lot of selling after this buying. That's not the best sign when you have a massive, really bullish move like that that gets basically completely erased. But if your entry was here, then you still have the ability to you have a you have the oh, you have the ability to set a stop still that would prevent you from having a large loss. Yes, it's painful to give up a large gain and then sell at a small loss, but that's better than seeing this thing have a small loss that turns into a big loss. You end up, let's say you bought at 14 on this breakout, you held up to here and you're like, oh good, like 80% gain, and then now you're at like a 2% gain. A couple days from now maybe you're at a 5% loss. Selling at a 5% loss after this is painful, but that's a lot better than selling at a 50% loss or a 65% loss. So if this holds and the overall broader market heads back up, I would expect this to probably do the same. But it might be difficult for it to see it get back up to where it was before. Maybe 20 is a more reasonable exit. What was the other one? RCAT. All right, bounce off the 200-day. Got a nice solid trend line of higher and higher lows. Very volatile. Very big trading range to trade around in this thing. Probably a little bit more, probably a good entry point, bouncing off the 200 here. A little bit of downside risk here to the bottom of the trend. If I was to enter here, I'd probably want to keep a stop tight and then plan to re-enter here down towards the trend line and then keep another tight stop in case it breaks down below that. And then maybe play it back up to the top of the range. But overall, this is very volatile. So if you're disciplined with taking small losses, then you can ride the big waves up. And you can do that with something as simple as like a trailing stop every time you enter. Have like a 5% trailing stop. or what's the average true range on this? 5% is probably too tight. Um, so the average true range right now is 138. So if you have like a, yeah, like probably like a $2 trailing stop, that would prevent you from getting whipsawed too much. But that does explode. That's like a 20%. So if I was trading this, I might be a little bit tighter and just know that I'm probably going to get whipsawed quite a few times, stopped out, and I have to re-enter, stop out, re-enter until I catch a big wave up. All right. From Anonymous X Lala, just tuned in. Do you think the bull market is over? No, I don't. I think when you take a look at the price action, especially today, this big wick down that recovered and we closed above support, it's pretty bullish. Um, we're still coming off of the heels of a 10% correction just a couple of months ago. This kind of price action, this kind of move up historically signals much stronger markets for the following 2, 3, 6, 12 months. Um, Fear greed index. Oh, shoot. Let's get rid of that. Okay. We're in high fear territory. That's a bullish sign. We've got median single stock short interest, the highest it's been in over 15 years. The last time it was this high was at the bottom of the bear market after the financial crisis. It's a very bullish sign. When you have a lot of fear, a lot of short interest, um, you get volatility, and I think those are buying opportunities. Um, all right, from KY0611. What app do you use to look at this? The app that I'm looking at is called Trading View. I don't know if it says that anywhere, if you can see it. But it's called Trading View. It's really nice. You can pretty much customize anything you want. You can see there's lots of stuff that I don't normally use on here that you can. You got stock screeners built in. You can link it to your trading account. So I don't know if you see up here, there's a buy and a sell button. So you can link it to your trading account, depending on where you trade. If you're trading at like Interactive Brokers or TradeStation or Alpaca, or I think Webull and Moomoo might be available as well. Lots of different brokers. That way you can just you link it so that you can click buy and sell straight through the trading software, and that executes those trades in your brokerage account. So that's nice. You can set alerts on here. You can do all sorts of stuff. I typically use it just for looking at the charts. You can set watch lists and all sorts of cool stuff. It's got a really good iOS app for your iPhone as well. So I like it. I use the paid version so that the ads don't pop up. And then with the paid version, you can also link it to your accounts. You can do paper trading on it as well to practice trading. So pretty cool. All right. From Troxist Magine. What percentage loss max would you tolerate before selling at a small loss? I, as a general rule of thumb, I like about 2% of my portfolio. So you can do this a number of ways. Like, number one, if you put your entire portfolio into a single asset, you can still make sure that you don't lose more than 2% of your entire portfolio if you sell that thing, if it falls 2%. You sell, you take your small loss, you only lost 2%. Even though you had a very large position, you still maxed your loss at 2%. If you put half of your portfolio in that asset, now you can lose 4% on it, and still you only lost 2% of your overall portfolio. If you put 10% of your portfolio in one asset, you could lose 20% on that trade, and that's still only going to be 2% of your overall portfolio. If you only put 2% of your overall portfolio into that single trade, you could have a 100% loss on that trade, and you still only lose 2% of your overall portfolio. And so position sizing is just a really easy and effective way to minimize loss potential, but it's not the only way. Um, you can hedge, you can use stops, you can just manually get out. You can there's the method you use to manage your risk is not as important as the fact that you do. Books that you recommend. Yeah. On my website, heresy.financial, click books at the top. I've got a little book list here. So I've got all my books on economics that I really like. These are all my favorite books on economics. You scroll down, you get all my favorite books on investing that I really like. Scroll down a little bit more, you get all my books on politics that I really like. Scroll down a little bit more, you get my books on managing wealth that I really like. History, personal development, business, trading, biographies, science, fiction. So these are all my pretty much all my favorite books. You can click more details, and there's a little find it on Amazon button. And if you click that button and buy that book on Amazon, then I'll get like 12 cents. Because affiliate links on books are not super lucrative. All right. From Adrian, do you buy back in even with wash sales? Yeah, I don't really pay attention to wash sales because at the end of the day, it's just taking that loss and like rolling it into your new position. And at some point, I'm going to exit the position, and so it's just adjusting. It's just delaying when I get to take that loss. And ideally, later on when I sell it at a gain, that just means like the taxable gain on that is lower. So I don't really pay attention to that because I'm not day trading. I'm not like racking up a ton of wash sales. So when I'm looking at the charts and I'm talking about stuff like this, like some of it is hypothetical because I don't day trade myself. I'm not actively like buying and selling the same thing multiple times a day. I'm a swing trader. So with my trading account. And so I'm not usually ever really worried about wash sales. Question from Live for Christ. What are your thoughts on Moomoo? I have the desktop app, but you can trade right off the chart. Is there any other place you'd recommend? I'm from Canada. If you're from Canada, I don't know. I don't know the best place to invest that you have available to you up there in Canada. I don't use Moomoo myself. I don't know of any reason why you shouldn't. I've never heard any really bad things. Never heard great things either, but from what I understand, they're good. Most of the time, it's just personal preference. If you like the user interface, you got good pricing. They've got customer service that you can contact when you need. If something happens and you're like, you need help with something going on in your account, like it's not letting you place a trade, you can't figure out why. If there's a real person you can contact. That's usually important a couple times a year. So other than that, it's usually personal preference, wherever you prefer. From Topher Brown, what are your thoughts on ASML? They've had a massive run up this year, and they seem like they have a monopoly on the backbone of AI innovation. EUVs already signs are a crucial geopolitical asset. It's not an AI play. It's like integral in everything. It's weapons, it's computers, it's it's like everything that currently makes the world go round, ASML is it's a it's a key, just I don't know if you would call it a bottleneck. It's just it is 100% necessary for like literally everything in the world. Everybody is trying to get to the point where they can not have to rely on ASML, and so far nobody can do what they can do. Um, I'm not long ASML right now, as far as I'm aware. I don't think so. Not with any significant position, but I think they're a key company for basically anything related to technology at all. All right, from Anonymous. How to stop FOMO. I had over 1 million in AI stocks during the war and sold it before it skyrocketed. Hmm. So I guess the FOMO would be, yeah, because you said now I have to buy it back at double or more the price. So the fear of missing out. Well, number one, you already missed out. So there's like reject the idea that like you have fear of missing out, because it's like, well, it's not like you already did. So it happened. So the question is, what do you do from here? Um, if you buy back in right now, then the real fear that's preventing you from doing that is it just falling from here. So you need to be hedged. You need to have tight stops. You need to like do something, make sure you're managing your risk so that if you enter that position again right here, you are not at risk of a large loss. Um, that's number one. Number two, you there's a cognitive bias that investors and traders face, that when you experience a loss or when you experience a loss of gains, mentally you want to make the money back from the thing that lost you the money. um and so it's like if you lose because you sold AMD at a small loss and then it ripped higher, the mental bias is you want to be able to either short or buy AMD to make back the money that you feel like you should have made the first time, and you feel like you need to do that from AMD. And if you were to make, let's say you lost out on $10,000 by a mistake with AMD. Let's say two potential futures ahead of you. Let's say you make back $10,000 in AMD by buying it again, and it rips higher. Or you could have made $12,000 in a completely separate stock in a separate industry. In terms of investing, the only thing that matters is the total wealth that you're able to create. So that second path of investing in something else that makes you $12,000 is better than getting back your $10,000 from AMD. But you will still feel, just know, you will still feel like you missed out even more if you see AMD rip up higher from here. Even if you made a little bit more in something else, you'll be like, well, I could have made back what I lost in AMD. It'll feel bad. But mathematically, you just need to know the only thing that matters is the total amount of money you make from here on going forward, and the total amount of money you lose being small, regardless of where it comes from. So as hard as it is, you need to notice when you feel that emotional pull to make back what you lost from something, and just say the only thing that matters is making money. So the best opportunity may still be the AI stocks that you missed out on, but it may be something else. Maybe it's energy, maybe it's commodities, maybe it's maybe it's memory stocks instead of semiconductors. Maybe it's software stocks instead of whatever. But the cognitive bias that you're facing is one that's very likely to get you into trouble, because when you try and make back from something that you feel like you lost on that thing, you're more likely to make a mistake investing rather than objectively just trying to find where's the next area that is I'm most likely to make the most money. All right. Um, from Mango H5H. What do you think about gold, silver, and Bitcoin? When do you think it'll be moving in the short term and the long term? Is downside risk small? I think the short term downside risk is higher than the upside potential right now. Bitcoin, we just broke down from this bear flag. Um, had a little bit of a recovery from this bottom, which was basically the bounce from this prior support, but that looks like that rally is failing. If we look at like a minute chart, that doesn't look the strongest here. Looks like that's turning over, and we're probably going to be headed a little bit lower. I think 50,000 ish roughly in here is probably a much stronger support level. Um, but I'm not trading Bitcoin. I dollar cost average. I buy a little bit every day, and I don't sell. Same with gold. Um, we're below the 200-day moving average. Don't have much support here. Have more support down here around 4,000. And then same with silver, broke down below the 200. Say probably next stronger area of support would be around 53, 54. Um, but this could also be a false breakdown here. We could pop back up and stay above right here. So short term risk is to the downside. I think with all these, the long term bullish potential is still strong enough to continue dollar cost averaging and buying, and just taking advantage of the price being lower and just buying a little bit day by day. Got any more questions for me, guys? All right, from Topher. How do you own your Bitcoin? Do you hold it in an exchange or transfer to cold storage? I think there is a good case to be made for holding your Bitcoin a couple of different ways, rather than having it all in one place. So, because there's pros and cons to everything. This is similar to gold, but if you have your Bitcoin by buying IBIT, Bitcoin ETF, the pros to that are that it's extremely price efficient. It's very cheap to buy Bitcoin that way and to trade it that way. Um, you get all of the price exposure that you want, that you need. So if you just need it for a little bit of just the price exposure in your overall allocation, it's really hard to argue that, doing anything other than just buying IBIT. Um, are we back? Let me know in the chat if we're back. Okay. I don't know what happened there. Sorry about that. All right. So we were talking about Bitcoin. What's the best way to own Bitcoin? Um, just for price exposure, it's really hard to argue against IBIT or any of the Bitcoin ETFs. Very cheap, very easy. Your money's already in there. If you're trading it, all of the tax implications are just inside of your brokerage account. So it's handled super easily. Really, really nice, easy, convenient, and cheap way to get price exposure to Bitcoin. Now, that doesn't help you if your goal with Bitcoin is to try and get some money outside of the financial system. um, for example, Bitcoin being designed to operate as money, permissionless money, means that if you have actual Bitcoin, you're able to take that purchasing power anywhere in the world, even by just remembering the seed phrase in your head, and send payment to anyone who will accept Bitcoin as payment for anything and not have to get anyone's permission. Owning IBIT in a brokerage account does not do that for you. It just gives you price exposure. And so having some in your brokerage account through a Bitcoin ETF, fantastic. Having some in a wallet that you have memorized the seed phrase, so that if push comes to shove and the world collapses into tyranny and you need to escape, and they're not letting anybody through the airports with with gold bars, they're not letting you transfer your stocks, sell them and transfer your cash to another country, whatever. Like financial repression sets in, capital controls, all that. You need to get out of here. You take your wealth with you in your head. Like there's a huge amount of risk mitigation and you know there's big advantages to doing that. But again, not all of it, because what happens in the off chance that you are accidentally not careful enough as you needed to be, and somehow your seed phrase gets leaked, you put it into a password manager that gets broken into or something like that. Um, there's always the chance that you accidentally made a mistake that you didn't know about, and you lose that Bitcoin. So again, not everything. Um, Another way that I think there's good reason to hold some of it in another way is through a multi-sig wallet. A multi-sig wallet means you need um, basically two of usually available three signatures to be able to authorize movement out of a wallet. And many times the higher inconvenience and the complexity and the cost associated with that means that that's really only going to be something that you should do if you have a a fairly high net worth, and so therefore you have a pretty high like dollar amount. um and that's like the safest, most secure way to store your Bitcoin. Swan Bitcoin is a service that they have something called Swan Vault, and they have it's a multi-sig wallet. You get two hardware keys, and then there's one like software key, and it needs two of the three to be able to access. And so you can physically separate the different hardware keys in different areas, so that because if you got both hardware keys yourself, fire burns down your house and destroys those keys, that Bitcoin's gone. Like it's inaccessible. So you want to separate those physically. So there's pros and cons to everything. The higher the security, sometimes the more complexity, or the higher cost, or the higher likelihood that something happens, and it just gets locked up and becomes inaccessible. So I like spreading it out. All right. Ooh, from Troxus Mungine. What is your favorite cashback credit card that you use, if any? Um, this is one area where I think at some point I would like to get into like credit card hacking. I see the videos from these guys who are constantly opening up new credit cards, taking advantage of the like new bonuses, the bonus points, and then transferring those bonus points, because my family, we do a fairly good amount of travel. Um, this year, probably on average, once every, like, we're probably, just as a family, we're flying places 10 times this year. Um, so we do a good amount of traveling. So I feel like I'm kind of like leaving money on the table by, like, I just use like a regular cashback credit card for everything, that just, it's like 1.5%, or I think it's 1.5%. Um, just for ease of tracking transactions. It's all in one place. Just get the cash back, collect it. Um, and because I found in the past, when I've used the ones where it's like, okay, you get only 1% back normally, but if you spend in these categories during these bonus months, then you could get up to like 5% or whatever. And then it's like, I feel incentivized to go spend money that I wouldn't have spent otherwise. And then if I don't, that I feel like I'm missing out on bonus points. But then I'm like, I'm just spending more money that I wouldn't have spent. And so it ends up costing me more money than like I end up with less money than I would have had otherwise. So up to this point, and I spent a good amount of money, like on my credit card, like more than a typical annual salary. So I feel like I'm missing out on like just, doing the credit card hacking. But then you look into the amount of time and work that it takes to track all those bonuses and do the work of the transferring and then you weigh it and you're like, okay, well, if I just spent that time working and making more money, then even though I'm leaving money on the table over here, I'd still be losing if I tried doing that. It's better for me to focus my time on just earning more money than you know, end up with more in the end. So I don't know. I go back and forth on it. I think at some point it might be worth trying to get into, but right now I just use a regular one that's like 1.5% on everything. All right. From Nice Guy 0001. If society is collapsing to the point where you are leaving the richest country in the world, I'm assuming Bitcoin also crashed along with everything else valuable. Right now, this year, I believe, there are a record number of people leaving the United States. So just because everything hasn't completely collapsed into outright tyranny does not mean that the conditions have not gotten to the point where for you personally, it might be better for you to leave. Now, it's an individual decision, meaning like where you live, it's not just a financial decision. Sometimes you choose to live somewhere that is more expensive because you like the schools that your kids can go to, because your family is close by, because your friends are there. And so even though you might save a couple $100,000 a year by moving to Puerto Rico in federal income taxes, maybe you don't want to live in Puerto Rico. Maybe you want to live somewhere else that you prefer to live more. But for other people, it's like, well, if you're not tied there for your family, if your business opportunities are the same or even better in other countries, just because America is the richest country, like with the numbers, there are other countries that have more wealth per capita than the United States. There are other countries that have way better tax structures, like Singapore, UAE, some of the Caribbean islands. And it's like, if you prefer that lifestyle with the different tax regimes that they have, and your business opportunities don't change or are better considering the all of the trade-offs, then yeah, you might be better moving there. And also, I think there's a good chance that it's not going to be it's not going to be an all at once immediate crackdown where it's like, all right, suddenly there's financial repression, suddenly there's capital control, suddenly we're living in outright tyranny. It never really happens like that. Usually it's just a slow burn, like a ratchet. Things get tighter and things get tighter and things get tighter. And so getting to the point where expatriation becomes more expensive and harder doesn't necessarily mean that everything has already collapsed. It just might mean that leaving with a significant amount of wealth becomes problematic. And expatriation means that your exit tax becomes 25% or your exit tax becomes 50% or more. All right. Rethink Rich. What are the pros and cons to leaps, and do you use them? Yeah, I use them all the time. There's no like line in the sand where something is a leap and something is not. A leap is just an option contract that doesn't expire for a long time. And so when you're looking at a potential trade, like let's say you're looking at Amazon and you're saying, okay, well, I think Amazon is incredibly undervalued. I think its growth potential is out of this world. Um, but in the short term, Amazon can, have a 55% drop. Amazon can have a 32% drop. Amazon can have a 23% drop. Amazon can have a 13% drop. So you're like, all right, in the short term, I don't know what Amazon's going to do, but I think a year and a half from now or 2 years from now, it's going to be worth way more than it is right now. And I want to be able to take advantage of that with some, extreme leverage. Then that's what a leap is for. It's just you're purchasing the right to buy these shares for a longer period of time instead of for the next month or the next 6 months. So there's no real objective inherent line in the sand on what is a leap versus not. You're just some options expire in one day, some options expire in 2 years. It's just the time frame of your trade. All right, from Unknown YTX. Would you ever consider upping your balance of gold to 10% and dumping Bitcoin? I do 20% in gold. And so gold, in my portfolio, gold is my reserves portion of my account. Um, and so, and my Bitcoin allocation is 5%. And so, um, if Bitcoin goes to zero, then my Bitcoin allocation goes to zero. um, if Bitcoin becomes used as money later on, then my Bitcoin allocation would automatically become a lot more than 5%. And eventually that means it becomes used as money, which means then Bitcoin becomes my reserves portion of my account. Um, and so I don't think there's a good reason to have the reserves portion of your account be much higher than that, because you're just giving up on growth in the long term by not having enough exposure to income and growth assets like stocks. All right, from Atlas 4225. How would you hedge against potential deflation, assuming bonds fail to keep the Ponzi scheme liquid? Um, Deflation is caused by the money supply rapidly shrinking, and therefore prices must adjust downwards to reflect the lower supply of money. A lot of times this is accompanied by large scale debt defaults as well. Um, and if there's one thing that the Federal Reserve has proven that they are committed to doing above and beyond anything, it is preventing deflation. the To anybody who is even loosely associated with the Federal Reserve at all, the biggest scar, the biggest stain in the Federal Reserve's history, according to them, is allowing the deflation to happen that happened during the Great Depression. Because as Milton Friedman said, which he's wrong about, but he said inflation is what is the quote? Inflation is everywhere and always a monetary phenomenon. And he's getting at the quantity theory of money, which is not complete, and so therefore it is false in some ways because it ignores the other side of the equation, which is growth and productivity. However, it is true that you can outprint any deflation, and the Federal Reserve was unwilling to do that. Now, again, I'm not saying that would have solved the problems. You can't print production, but in terms of prices falling, you can outprint that. Now, it's possible that would have tipped them over into hyperinflation if they would have tried to fully do that. That is very possible. However, I think deflation is one of the lowest likelihood risks that we need to prepare for. It's not zero, but it's not a top priority in terms of protecting against. So how do we protect against it? Well, number one, we want to make sure that our cash is spread out so we never exceed the FDIC limits anywhere. Number two, we want to make sure that we still have some gold because the price of gold will fall, but the purchasing power of gold stays the same. And so even in the case of deflation, when the dollar price of gold falls, the amount of stuff you can buy with that gold still usually stays roughly the same. Number three, we do want to have some cash. This is one of the reasons why I talk about a 5% cash allocation, because in the case of deflation, that 5% cash allocation becomes worth a lot more in your portfolio because the other portion of your portfolio gets a lot smaller. In deflation, cash gets a lot more valuable. And so you want to have your cash appropriately spread out so that you can use it in deflation. It does protect you against deflation. All right. From Brian R. I understand that all past IPOs in the US together equal 1.5 trillion. The tech ones in the next few weeks equal 4.5 trillion. Where's the money coming from? Well, number one, it's not $4.5 trillion that is being raised. That's simply the valuation of the companies. So, like, go watch my video on the SpaceX IPO. I did it a couple of days ago. And the $2 trillion SpaceX IPO, they're only raising $75 billion. So the valuation of the company is based on, okay, we're going to sell a tiny percentage, 3% of our company. And based on the price that people are willing to pay for those shares, that means that the rest of our company, if we were to sell it, which they're not, is worth $2 trillion. If they were actually trying to raise $2 trillion, they wouldn't be able to do that. They wouldn't be able to have that value. Like, that money couldn't, where's that money going to come from? That'd be very, 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 very difficult. But they're only raising a very small amount. And so it's just assigning, okay, people are willing to pay $100 per share or whatever for a few shares that we're selling. And because that's the price people are willing to pay for a small percentage ownership stake in our company, our whole company is worth $2 trillion. And so they're only raising 75 billion. So the money is just coming from a little bit from other stocks and a little bit from cash. It's really not that much in the scheme of the financial system. Has anyone ever said that you look like Derek Jeter's brother or cousin? I haven't gotten Derek Jeter. I believe Derek Jeter, what is his ethnicity? Because I am like white, like every European country. Like, I'm a like ethnicity, like European mutt. I think I'm my largest percentage is like German and Ukrainian, but I've got a lot of Swedish, I've got some Irish, like just complete, like, you're like, there's nothing. I don't even know anywhere where anything, that is darker skinned. I think Derek Jeter is part Latin. What is his ethnicity? Yeah, he's biracial. He's got an African American father, a white mom. Yeah, I thought he was. Yeah, so he's half black. So no, I've never gotten Derek Jeter before. Now, I will admit, like, I do spend, like, pretty much every morning I drink my coffee in the sun, so I get a good amount of sun exposure. So my tan, sometimes people assume that I have, like, some, Middle Eastern or something, because my skin does end up being darker from that. But and then also just the bald with the beard. It's a very common look. In fact, just to be honest, like, I know quite a few people who are, like, they have online personalities, whether they have, like, they're on Instagram or whatever. They've got their businesses, like, they make content. And so, like, people with much smaller audiences than me talk about how much they get approached in public. And I actually get approached in public very, very rarely. And I think it's for a couple of reasons. Number one, when you see a bald guy with a beard, like, a bald white guy with a beard, they all look the same. Like, I really think for the most part, like, people don't actually recognize me in public because you see the front of my face, but, like, if you see me from the side, like, you don't see the side of my head mostly in my YouTube videos. So you see me walking around, the city or a store or whatever, like, you're not really going to be sure that it's me, even if that thought does pop in your head. Number one. Number two, I tend to be very, suspicious publicly. And my wife tells me all the time that I look like I'm I'm expecting people to try and come up and fight me. Like I have a fit like my resting face, like I have RBF, like I always look very angry in public. And so I think if somebody you like I quite often people will make eye contact with me and they'll do double takes and they'll look back at me and I'll notice them out of the corner of my eye. They'll turn around and look at me like while I'm walking away. And I think people do, tend to recognize me more than they come up, but I look like so like aggressive or angry that they don't actually approach me. Um, and so, and so no, I don't get Derek Jeter. I think I look a lot more similar to just your average generic white bald guy with a beard. So I don't think people recognize me as much. And when they do, they don't come up to me because they think I'm gonna be angry. But if you ever see me in public, I won't be angry if you do approach me. I'll shake your hand and talk to you and smile. I won't be upset. All right. Mm. All right, from Lawrence Thomas. You sound religious. Don't you think they are building out the beast system with digital currencies to fulfill revelation? If you don't receive the mark, you can't transact. No, um, not at all. In fact, everything that was written in Revelation was talking about what had already happened at that time. Um, the mark of the beast was Caesar's face imprinted on the coins. The number 616 and 666 are conventional at the time, conventional alliterations to to the emperor at that time. It's just the number way of spelling out his name, whether you're looking at it in Greek or I think either Aramaic or Hebrew was the other one. Can't remember. So no, nothing about payment technology today has anything to do with what was written about in Revelation at all. All right, from Gears 454. Oh, okay, that's not a question. From Topher Brown, any chance the eventual private credit bust, whenever it could be, or whenever it may be, would be the end of the game for the dollar legitimacy? Funds are getting more and more embedded in the system. No, in fact, the more of a problem it becomes, the more likely it is that it's a too big to fail type of event that would get some sort of institutional bailout because of the how it's embedded in the pension systems. So I think bank deregulation will solve that problem, but if it doesn't happen soon enough, then there will be some sort of fiscal policy funded by monetary policy to try and bail out that problem because it's well enough embedded in the financial system where I think the losses everywhere, like in pensions and on bank balance sheets, would be large enough where they'd be like, all right, this is a systemic crisis. We need to handle this. Similar to how the unrealized losses of treasuries on bank balance sheets could have caused bank runs and bank collapses back in 2022. Is that 2022 or 2023? I can't remember whether it was 22 or 23. Either way, Fed was like, all right, bank term funding program, unrealized losses don't count. You can sell them to us at full price. So I think it's embedded enough where it's like, if that does start to spill over and become a problem before interest rates go down from something like bank deregulation, we'll get some sort of a bailout for it. All right, from Clay, 1996. What branch of Christianity do you most identify with? I'm a new convert and I'm leaning Catholic, but I'm not sure. Well, I don't know. I think there's a lot of I think there's a lot of good that comes from long-standing tradition. I think there's a lot of good that comes from that. I also think there's a lot of s staleness, um, that can come from that as well. There's I think the one thing that I am pretty certain about is that there's there's no branch or denomination uh, or organization where you're gonna be like, "Oh, this is 100% the truth." Because at the end of the day, humans are humans and humans are flawed, and when humans create a movement that, ends up doing some good, eventually they create an organization around it and, look at what they've done and try and protect it, and the when you, when you read about the armor of God, what you'll notice is there's no armor on the backside. Um, it's it's an offensive doing good in the world and transforming the world is an offensive posture. And anytime you try and turn around to protect what you've built instead of advancing forward, you end up you end up losing the plot. So there's no organization, no branch, no denomination in my opinion that has it all together. If you try and find it, you'll be disappointed and you might throw the baby out with the bathwater. So I think following Jesus despite the flaws in any branch or organization or denomination, it's important to keep your eyes on the prize and not get distracted with the creation of humans. All right. What are your expectations around the next Bitcoin cycle in correlation to the increase in money supply? I am not I am not a big believer in the Bitcoin cycle. Anytime there's some sort of a cycle that as is noticed, it tends to get priced away because when there's a predictable pattern, um, more and more money will rush in to try and take advantage of that pattern, which prices it out of existence. If the Bitcoin cycle is intact, then I think you should see the bottom in Bitcoin sometime in later this year around October. So we probably have a couple more months of pain and then big upside from there. But then you also have to ask, okay, well, around that same timeline, we probably looking at things like the passage of the Clarity Act and institutional adoption, purchasing from other areas, maybe a strategic Bitcoin reserve purchasing through the US government. So there would be other catalysts that would be at play as well. I don't think a cycle in and of itself is anything to really put too much weight in. All right, from Sir Calvin 83. Hey Joe, interested in knowing what strategy you use to identify when and which sectors to rotate your previous gains to within your portfolio. I wouldn't say that there's like a specific strategy in order to rotate in and out of different sectors or areas of the market. Because before I enter a position, I always have an exit planned. And like for example, one of the trades inside my trading group that we just recently exited, I think it was last week, was AGIX. AGIX is the Crane Shares Public Private AI and Technology ETF. They hold things like NVIDIA, Google, Microsoft, Meta, Apple, Amazon, Taiwan Semiconductor, Broadcom, those kind of companies. And I can't remember the exact price that we exited. I think we exited right around 45. And a bunch of the traders in my group, when we exited, they're like, "Why are we exiting here? It's still going up." And it's like, the point is not to nail the top or nail the bottom, like buying at the lowest price possible, selling at the highest price possible, because that's impossible. Nobody has a crystal ball. We don't know how much higher this will go. We don't know if there's a blow off top. We don't know. We don't know what's going to happen. And so we have to come up with an educated position on, based on what the price action is doing in a given period of time, given catalysts that could take us there along the way, what is a reasonable price that we expect that this thing could get to? Let me pull the exact date up so I can give you the exact date that we closed out. Okay, so we closed out on June 1st. Oh my gosh, that is crazy. I didn't realize that was Did we really close out on June 1st? Let me double check that. Yeah. Wow. All right. So we closed out on June 1st. So I guess kind of contradicts the point that I'm trying to make, that we can't nail the exact top. And ultimately, I think that there's a very good chance that we didn't, that this is a temporary sell-off and that this thing continues to go higher from here, especially after this sell-off and this recovery here. Maybe this is another good entry point. But the point is, I did have a lot of people asking me, why are we selling here? This thing looks like it's going to continue to go up. And the answer is because we hit our target. We hit our profit target. We knew what price we were getting in at. We knew what the risk and reward was. We knew how much we were allocating to this trade. We knew what the maximum loss was going to be, and we knew what our profit target was. It's about an overall system that makes you more money than the market. If you can't beat the market, there's no sense to spending any amount of time and effort trying, because you're just wasting your time and effort. Might as well just put your money in the index funds and focus all of your time and attention on earning more money so you can invest more money. So it's about building a system that you stick to so that you can go back and tweak it along the way. So we ended up getting out, and right now that looks like a genius trade, although I think this will probably end up going higher than where we got out at. Either way, it's not about hitting the top and the bottom. It's about identifying areas in the market that seem like they're probably undervalued or seem like they're probably overvalued, looking at the risk to reward, looking at the pricing on that to see if the market is already pricing in the move that you expect to happen, and then seeing how much you can make on that, because most of the time with speculative trades, you will be wrong. And so you want to make sure that the ones that you're right on will make you enough money to make up for the ones that you were wrong on. And so then when you hit your exit, you get out. And so I don't think that it's necessarily really about trying to identify, okay, well, all the money is done in this area and it's rotating into this area. Like it's semiconductors and memory chips are done. Now, next area is like software. It's like maybe they both go up now from here. I don't know. But we're just trying to find areas of the market that have the potential for a move, catalyst to get us there, and pricing that is not, that hasn't priced out the profit, the move that we think could happen. All right. From Topher, do you use Claude or other AIs for deep stock research, analysis, and even situational reasoning and scenario planning? Um, I am trying to use various AI tools, but probably Claude the most. Um, More and more in many areas of my business. Um, this is my opinion, and I could be completely wrong about this. AI is really good at doing lots of really, lots of different tasks. You can have it design things for you, like infographics. You can have it do research for you on stocks. You can have it perform tasks for you, like send emails, and um, like you can have it do all sorts of things that you used to have to hire people to do. And so for some people, it is very, very, very useful. The problem is, in order to get a lot out of it, your skill set has to be a really good business leader. Like, if you're bad at hiring people and you're bad at managing people and you're bad at training people, you will not be able to profitably use AI for really anything. Because at the end of the day, it's like a digital employee. It's like, you have to know exactly what you want, and you have to be able to teach it what you want it to do, correct it when it does it wrong effectively, and continue that process so that it continues to do more and more of what you want. That's the job of, like, very minimum of a manager, but probably even higher up of a people leader. And it's a very hard skill. And just for, like, to be, like, straightforward with you guys, I'm not good at that. My biggest weakness and it's the thing I'm trying to fix and learn the most right now. It's my biggest bottleneck that I'm focusing on. But my biggest weakness in running my business is hiring, training, and delegating. Like, it's not a natural skill of mine, and it's a hard one for me to learn. Um, I know there are other people out there that's something that they are really, really good at. They're really good at finding good talent. They're really good at training people. They're really good at managing and delegating. And when you're good at those things, you can use AI really effectively to do all sorts of things for you, because you know what you want, you know how to communicate it to others, and you know how to correct it in order to get the results that you're wanting. That's all it is. And so I've found it very difficult, and it's something that I'm getting better at slowly, and I'm slowly but surely attracting. Recently I've picked up a couple of really, really, really highly skilled and talented people for my team. And I'm very thankful for that and for them. But it's partly out of luck. Like, and so at the end of the day, yeah, back to the question about AI, I'm trying to use it more. One of the things that I've found it most helpful for is just gathering the initial research, like, specifically regarding investing. It's like, hey, if I want to do a deep dive on this company, instead of going and finding all the documents myself and reading through a bunch of stuff that doesn't really matter, it's really good at gathering, distilling, summarizing, and clarifying a wide body of information into something that is more packaged up and useful. And so I've been able to use it pretty effectively for that. But in terms of, like, helping me make investment decisions, I haven't found it to be too helpful yet. And I think that's my problem. I don't think that's a problem with these tools or the models. I think that's just a skill issue on my part. All right, guys. I don't know if it shows you the time on this live stream, but we just passed 4 hours. um, so I'm going to end it here. And you can watch it, the whole thing, if you want, because it'll be posted, and I'll clip these out, like I always do, for the short form content as well. So appreciate you guys. Lots of good questions. As I always say, I'll continue doing these things as long as you guys continue to show up for them. And we'll see you on the next one.